That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome to the European market open. A minute to go until the start of cash equity trading. I'm Tom McKenzie in London, and here are your top stories. HSBC considers a special payout after pre-tax profit jumps 92% in the fourth quarter. The bank also cuts its bonus pool. We will check the shares in Europe after they drop in Hong Kong. Ahead of the Fed's minutes tomorrow, stocks and futures slide as investors weigh the prospects of higher rates for longer. Plus, President Biden pledges more military support for Ukraine during a surprise meeting with President Zelensky in Kyiv yesterday. Biden meets the Polish president today. Let's take a look at these futures then. Of course, the US will be reopening today after President's Day yesterday. You had basically a little change across European markets yesterday. A Bloomberg survey of forecasters expects the benchmark in Europe to end at 455 for a little 2% move lower by the end of the year. The FTSE 100, we're just waiting a few seconds for that to price. We have iron ore jumping. We'll see if that plays into the basic resources space more generally. Earnings coming through from the likes, of course, of HSBC and BHP. Over in Spain, the Spanish IBEX down 0.3%. Interestingly, Goldman Sachs now matching that money market view on the ECB, moving ahead to 3.5%. The terminal rate then, that is a view from Jan Hatzius and team at Goldman Sachs. When it comes then to the prospects of this European equity market rally that we've seen year to date, the likes of JP Morgan, the likes of Bank of America are saying it is going to start to fizzle. It's run too far already. Currently, the FTSE 100 down 0.3% in the session today, off 23 points. The Spanish IBEX, as I said, down 26 points as well. Over in France, the CAC 40 off by 0.2%. Let's move things over and see how things are playing out, particularly in the yield space. That move higher in terms of the US two-year yield. That yield inversion remains pronounced, of course. There's the two-year, 465, a move higher by 4 basis points at the front end of the curve. And again, coming back to the Goldman Sachs view, we've looked at the ECB in terms of the Feds. There is an expectation now that you're not going to get a cut through from the Fed. This is according to Jan Hatzius, until 2024 at the earliest. Futures stateside pointing to losses of 0.6%. Euro dollar at 106, just to move lower by about 0.1%. And Brent in focus again, $83 a barrel, down 0.6% after a pretty decent rally yesterday. Again, it's the pull and tug of the dynamics around China demand versus the Fed hikes and what that does to the broader global economy. Let's check in on HSBC then. The shares dropped in the Hong Kong session, opening now here in the UK, currently down 1.7%, despite the fact that they came in with a beat in terms of the earnings and are considering a special payout when they conclude the sale of their Canadian business. 610 then on HSBC. Pre-tax profit beating estimates, as I said, rising 92% in the fourth quarter. CEO Noel Quinn tells Bloomberg he is not overly concerned with the performance here in the UK.
From my own portfolio, what I see through our consumer business, our retail business, we're not seeing any major signs of stress at the moment in our retail business. It's in relatively normal territory. In our wholesale and commercial banking business, I think there are some corporates that are starting to feel some cash flow pressure because of higher inflation and higher interest rates. But again, that's still fairly marginal, I would say, at the moment for us. So I'm not...
Okay, HSBC CEO Noel Quinn there speaking to Manus Cranny. We're going to bring you the full interview later in the show as well. Really important conversation there with the CEO of HSBC, so do not miss that coming up in the next 10, 15 minutes or so. Let's check in on some of the other lenders then across the European space. HSBC down 1.5% currently. NatWest off by 0.6%. Over in Spain, of course, but also a massive retail presence here in the UK. Santander, just a range bound on that stock currently. BNP over in Paribas, unchanged. Just to check some of the lenders here on the back of those HSBC earnings. Top line was a beat, but the stock is off this morning. Now, European stocks and US futures dipped this morning as investors weigh the prospect of central banks tightening policy further than previously expected to tame inflation. Goldman Sachs' chief economist, Jan Hatzius, as I mentioned, says the Fed still has work to do.
We've seen some higher inflation numbers for January. I don't necessarily think that that breaks the trend towards disinflation, but I think it reinforces the idea that the Fed still has work to do. And so we think another 75 basis points from here with no cuts until 2024 seemed like a more likely outcome.
Okay, let's bring in our guest this morning, Sonia Martin, Chief FX Strategist at DZ Bank, and Eddie van der Volt, Deputy Managing Editor from our Markets Live team. Sonia, good morning. Let's start with you then and your views. How have you adjusted your views on the terminal rate for the Fed? I was speaking to RBC Capital Markets and their rate strategist yesterday. He was saying that actually he's concerned that the markets may be fading the cuts from the Fed a little too soon. And then, of course, you hear there from Jan Hatzius of Goldman saying they're not going to come through until 2024. Where do you stand on this?
Well, to be honest, we haven't really changed our view very much because we have been saying for some time that the terminal rate will be around 5.25, and we haven't changed that view. I think more importantly, we had no rate cuts in the forecast, even at times when the market was pricing in 50 to 75 basis points in cuts by, the beginning of next year. Currently, we're looking, as I said, for the terminal rate to go up another 25 to 50 basis points, stay there, and then the first rate cut, in our view, will come early in 2024 and no earlier than that, since inflation is just going to be too high for that to happen earlier.
How does that view support the US dollar then, Sonia?
Well, it did, obviously, recently. We have seen that the pricing out of rate cut expectations has lent some support to the dollar. We've seen euro-dollar coming off this intermittent highs around 110 towards now 106. So I think that move has already happened. We have seen the correction. And I think, at this point, there's not much additional support from the dollar from this story. So I think we're now looking for other factors for guidance on the dollar.
Eddie, let's bring you in at this point then as we focus on the equity markets. We've got the Fed minutes coming out Wednesday and, of course, the PCE index on Friday. We know that's important for Jay Powell. What is the next catalyst, do you think, for US equities? And then we'll get your view on what's happening here in Europe.
Yeah, absolutely. Look, I think that was a very prescient view from Sonia, because the rest of the market definitely got this very wrong. A lot of people were expecting cuts, and they were expecting cuts because they were expecting a US economy that will weaken substantially. We're not seeing any signs of that, and I think that is the kind of data points that we're looking for here. If we're not seeing any weakness come through, then this market, then this view that rates will go up and stay high will become more and more entrenched. And I think that is the move that we've seen across the bond market at the moment.
Eddie, on your views on European equities then, the Bloomberg survey of forecasters, 15 or 16 forecasters, with a view that European equities, the benchmark Stock 600, is going to end the year at 455. You're currently at 463. There's concern expressed by JP Morgan, by Bank of America, that the rally year to date has overrun. Your view on that?
Yeah, look, a lot of people got the equity rally wrong already this year, right? Stocks have done fantastically well, and it wasn't really in the script. So I take it with a little bit of pinch of salt that people are now turning so negative on equities. I do think that there is a case to be made that equities are becoming a little bit of an inflation hedge, saying, look, if inflation is that sticky, where do we want to be? We want to be with companies that can hike their prices. Now, that does not mean that the companies that did well last year is going to do well this year. I do think that we see a rotation. I do think we see a lot more active management in the market again this year, and that will be the way to outperform the market. What that means on an index level, I think we will see the indexes suffer a little bit because they are very geared towards tech and towards growth at the moment, and that dominates. And I do think we see value, maybe even banks, as we see these higher interest rates still outperforming.
Sonia, I want to bring you back to the US dollar, and I just wonder, given the week that we have right now, we're only early into it, but the reminders that geopolitics, again, front and center, the geopolitical risks, and whether there's a haven bid again for the dollar that isn't being factored in at this point.
Well, I think right now that's not necessarily a problem. I think the interesting question will be how this develops throughout the year. And I think, some people will be becoming very bearish on the dollar. When euro dollar was trading around 110, people were saying, this is the beginning of a bigger trend. And one of the reasons why we don't necessarily share that view to that extent is because, there is still geopolitical risk, plenty of it going around. And, as the year progresses, we cannot rule out at all that new factors, new crises will come up throughout the year. And that will support the dollar slightly. That doesn't mean it can't depreciate as the year goes on, but it does certainly mean that we shouldn't expect the dollar to be, one of the weaker currencies in the G10 space in this year.
And Eddie, briefly before we let you go, the FX effect across European equities then, the benefits, of course, of weaker euro last year to corporate Europe, and whether that starts to fade in 2023, what kind of headwind could that provide?
Yeah, that's absolutely a really big factor. The direction of the dollar will make all the difference, I think, for broad assets, whether we're talking about US equities, whether we're talking about commodities. I think that will be the biggest input here. The view on the dollar, still a little bit more bearish, I think, across the market than certainly it was last year. I think, but if we do see the Fed continuing with its rate hikes, then the expectation that the ECB will out-hawk them, I think that fades a little bit. So I think just purely on a rates perspective, from a rates perspective even, the dollar could still do well this year.
Okay. Eddie van der Walt, thank you very much indeed. Deputy Editor, of course, of our M Live team, and Sonia Martin, Chief FX Strategist at DZ Bank. Staying with us, we'll get more of her calls on yen, euro and pound in the next few minutes. Coming up, HSBC's UK shares open lower, but CEO Noel Quinn tells Bloomberg he is upbeat on the bank's global business. More from that interview next. This is Bloomberg.
Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
Okay. All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. season continues.
The chips are down.
Earnings coming in fast and thick.
A slew of bank earnings this morning.
Bloomberg breaks the numbers first.
Numbers coming through from Shell.
LVMH numbers are hitting the tape right now.
We had a very good set of numbers in the fourth quarter.
Feel confident with the guidance we've given.
The situation has changed completely.
With exclusive expert analysis.
Europe's most valuable company.
Trending towards the higher end of its historical range.
That can continue. How do I play this into 2023?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back to the Open. We are 13 minutes into the European trading session. Dollar is bid, yields are higher, equities are off. Across the benchmark here, down 0.1%. Futures in the US as they look to reopen after a national holiday yesterday, currently pointing lower by 0.5% on the S&P E-minis. HSBC, one corporate in focus. Of course, it was a beat on their results. We've been speaking to their CEO. Currently, that stock off by 1.3%. So, yes, HSBC shares in Europe trading low, following a drop in Hong Kong as it forecasts a softening in the housing market. The lender is considering a special payout and new dividend issuance after the sale of assets in Canada and China. CEO Noel Quinn tells Bloomberg he's happy with the changes under his leadership.
If you go back 3 years ago, as you'll know, we were very dependent on profit generation coming from two principal markets, Hong Kong and the UK, with a strong international banking franchise overlaying that with transaction banking and international wholesale banking. What I'm really pleased of 3 years later is a radical change in the profit generation by geography. The Middle East alone last year generated 1.8 billion of adjusted pre-tax profits. Our troubled market in Europe 3 years ago produced an adjusted pre-tax profit of $2 billion. Our US business, again troubled 3 years ago, produced an adjusted pre-tax profit of $1 billion. And even within Asia, we got good diversification. Outside of Hong Kong and China, we generated more than $4 billion of adjusted pre-tax profit in 2022. So that gives me a solid base of geographic profit generation, supported and overlaid with a strong international banking franchise and a market-leading transaction banking franchise. So that gives me confidence in our 2023 forecast. Now, to come to your point on net interest margin, our guidance on NII is 36 billion plus, in excess of 36 billion. We believe that we still have upside. Our NII in 2022 was 32.5 billion. We're guiding to in excess of 36 billion in 2023, so good growth. There are some uncertainties on the horizon, but we're still positive. We know where consensus is at the moment, and we think consensus is in a reasonable position. So we're not looking to change guidance on NII, and I think we're pretty confident we have a good prospect of delivering our return next year.
HSBC CEO Noel Quinn speaking to Bloomberg's Manus Cranny earlier following those results. Some redheads crossing the terminal that are building out the picture in terms of the health of this Eurozone economy with a focus on France. February manufacturing, and it's divergent. There's a big divergence between manufacturing and services. Manufacturing PMI for the month of February out of France coming in at 47.9, well below the forecast of 51, clearly in contractionary territory. Manufacturing. Services PMI, though, for the same month of February, 52.8, well above the forecasts of 49.8 and comfortably in expansionary territory. So 52.8 for services PMI for France, 47.9 for manufacturing, euro-dollar 106. Currently off by about 0.1%. There was a little pop in euro-dollar, but that's coming off now, pairing on the back of that data. We've got more Eurozone PMI data out throughout the morning, which we'll bring to your attention, of course. But again, that divergence between manufacturing and services is pretty pronounced. Sonia Martin, Chief FX Strategist at DZ Bank, still with us. Sonia, your call on euro-dollar over the next 12 months, 115. How do we get there?
Well, it's partially a euro, partially a dollar story. So when you look at the next few months, I think it's more of a euro story to the extent that we have a brightened outlook for the Eurozone economy. The fear that we had that we would have this very, very difficult winter, potentially energy supply issues haven't come to fruition. Things have been better than expected. And then on top of this, we have the improved outlook for China, which, whose economy has sustained the COVID hit much better than feared. And all of that brightens the outlook for the Eurozone. We also have the ECB hiking more aggressively at this point, at least in terms of rate hikes to come than the Fed. So that's going to support the euro. Now, the other side of the coin, we have the U.S. economy moving into, we still believe, a recession. And of course, in the summer, we have the big U.S. debt issue coming up, which is going to make for some very interesting political drama.
What do you make of this data? It is mixed. Manufacturing's coming off, clearly cooling across France at least. Services very strong.
Well, it's sort of, you can pick whatever side you prefer to be on. It is very mixed, and that's the problem, really, isn't it? We have been seeing, mixed data, across the board. Some data better than expected. Then there'll be the occasional setback, and it's always sort of very difficult for the market, I think, at the moment to find clear direction. And this is why, even in the beginning of 2023, we still have this very high market volatility, because investors are sort of jumping on one data set and then onto the next, and then on a central bank comment, and then on the next, and there's really no strong conviction in the market right now. And this is going to probably be the case for some time to come and make for continued high volatility.
Sonia, do you have conviction when it comes to the yen? What's the next level you're looking for as we look up to Friday and the grilling of the next BOJ governor?
Well, yeah, that's going to be a really big event, because very little is known about Ueda at this point in time. He's been working as an academic, so it's a bit of a guessing game here. But the market has been pushing JGB yields higher this morning. We were above 0.5 for the first time since January. So that's, clearly shows which side the market is speculating on. But as far as dollar yen is concerned, we still have a very aggressive forecast, 120 with a view, a 12 months view.
120 is an aggressive forecast. Currently 134, bit of a pop for yen today, up 0.4%. Sonia Martin, always excellent. Thank you very much indeed. Chief FX strategist at DZ Bank on all things euro, dollar and the yen. Coming up, Joe Biden continues his Eastern European trip. He heads to Poland today. We're going to bring you the details next and a preview of that speech later from the US president. This is Bloomberg.
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now, we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
To keep rain World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
Welcome back to the Open. 22 minutes into the European trading day. Risk off across these equity markets. The benchmark down by 0.3%. Futures lower between 0.6 and 0.7 in the US. The dollar is bid. Yields are up. Let's get back to the geopolitics then. US President Joe Biden hoping to garner further support for Ukraine after that surprise visit to Kyiv yesterday, where he spoke of unity against Russia. Today, he is in Poland, where he will meet the Polish president. For more on this, we are joined by Piotr Skolimowski, Bloomberg's Warsaw bureau chief. Piotr, what is the significance of the visit by Biden today to Poland, to Warsaw, and what are we expecting to hear from the US president?
Yes, indeed. So it's a significant visit, although the highlight of this trip is probably going to be his trip to, surprise visit to Kiev last night or yesterday. And obviously what he is going to be expected to hear, or what Polish leaders want to hear from him today in Warsaw, is that essentially a very similar message, that the US is there for a long haul, the US will provide support, and the US will support the NATO so-called eastern flank, so Poland and other countries that used to be part of the communist bloc, and now since the 90s they've been members of the NATO, and they fear that this war will spread into their territory, especially in Poland. There's this constant fear that Poland is spending much more on military since the war started, and what they expect to hear from Biden is the U.S. will continue to support it, will be there, and there is no sense of fatigue.
Piotr, we cast our minds back this time last year, Beijing declaring a no-limits partnership with Russia. Now the Chinese floating a peace deal. What has the reaction been to that prospect?
Indeed, so China is trying to be sort of an honest broker here. They obviously floated this plan, and one of the top diplomats for China is visiting Moscow today. So he will probably meet Putin, and Putin will also give his speech today, a State of the Nation speech to. So after that, there is going to be a meeting probably. So China obviously has been the U.S. has been trying to kind of see or present China as being together with Russia here in this war, and China is trying to, obviously is realizing that they can actually play a role, that they can actually be some kind of a broker. The question is whether they can actually play that role, given its long-standing relationship with Russia and its long-standing support for Moscow and Kremlin.
Okay, Bloomberg's Piotr Skolimowski in Warsaw ahead of that visit by US President Joe Biden, of course. Thank you. Let's get to the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. Engie has reported a jump in full-year earnings and says it will hike its dividend by 65% thanks to surging energy prices. The French utility reported net recurring income of 5.2 billion euros, up from less than 3 billion a year earlier. BHP says it's optimistic about a demand recovery in China after it posted its lowest half-year profit since 2021. China's slowdown hit buying of iron ore, copper and coal, BHP's main sources of revenue. The world's biggest miner slashed its dividend after rising costs and softer commodity prices hit revenues. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Laura Wright. This is Bloomberg. Tom.
Laura here in London, thank you. Coming up, Capgemini CEO Ayman Ezzat joins us as the IT and consulting firm raises its proposed dividend on the back of strong fourth quarter earnings. That interview is next. This is Bloomberg.
what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. We are 30 minutes into the European trading day this Tuesday. Here are your top stories. HSBC considers a special payout after pre-tax profit jumps 92% in the fourth quarter. The bank also cuts its bonus pool. Shares in London drop.
What I'm really pleased of 3 years later is a radical change in the profit generation by geography. The Middle East alone last year generated 1.8 billion of adjusted pre-tax profits. Our troubled market in Europe 3 years ago produced an adjusted pre-tax profit of $2 billion.
Ahead of Fed minutes tomorrow, stocks and futures slide as investors weigh the prospects of higher rates for longer. Plus, President Biden pledges more military support for Ukraine during a surprise meeting with President Zelensky in Kiev yesterday. Biden meets the Polish president today. Let's check in on these markets then. Risk off across the equity markets. You're seeing a stronger dollar. You're seeing yields up across the Treasury curve. Across the benchmark then, here in Europe, down 0.2%, 463, and a Bloomberg survey of forecasters pointing to 455 for the European benchmark by the end of the year. You have the likes of JP Morgan, Bank of America saying that the year-to-date rally for European equities has gone too far. The DAX currently off by 36 points, down 0.2%. Here in the UK, the FTSE 100 still holding above that 8,000 level, but off just a little over a tenth of a percent in the session today. Let's switch on and see how things are playing out across these sectors. Technology taking a hit as yields grind higher. The 2/10s inversion remains pronounced, of course, in the US. Bottom of the list then, technology down 0.9%. Financial services also off by 0.8, and basic resources down 0.6% as well. Of course, the demand factor out of China remains debated in terms of how stimulative that will be. BHP Billiton, we're going to be hearing from them later in the show. They are betting on stronger demand out of China. A bit of a safe haven swivel then in terms of these equity markets. Utilities getting 0.5%. We have, of course, data coming out of the European Union that's just building out the picture in terms of the strength of the economy. We had France coming out with its services and manufacturing, and there was a big split there. In terms of Germany then, here's what we're looking at. If you can just roll the prompt back so I can take a look. Euro dollar, by the way, just off by 0.1%, 106. German February manufacturing coming in, PMI 46.5, below the forecasts of 48.1, of course, firmly in contractionary territory. Services, though, again, we saw this with France, a different picture. Services PMI for Germany for February rising to 51.3, just above the forecasts of 51. So services for both Germany and France remaining strong and clearly in expansionary territory. Manufacturing continuing to be squeezed. Let's get back to the earnings story then. Capgemini, fourth quarter earnings, sales growth and free cash flow coming in ahead of estimates. The French IT firm says it sees organic free cash flow of around 1.8 billion euros. We are joined now by Capgemini CEO, I should say, Ayman Ezzat. Good morning, Mr. Ezzat. Congratulations on these results. Let's start then with these numbers. The key takeaways as you look ahead to the growth prospects for 2023, macroeconomic picture is looking uncertain. We may not be getting a recession in Europe, but clearly, as we've been saying around the data that's been coming out from PMI, manufacturing and services, a big split there. How is the macroeconomics playing out for your business as you look ahead to 2023?
Listen, we consider the trend to continue to be positive in terms of growth because we have this structural transition towards both a digital and sustainable economy. And this is driving structural growth for years to come. Of course, the macro in 2023 is having an impact. And where it impacts is the decision-making of clients. So the intention of clients are very high in terms of transformation, in terms of digital transformation, but we start to see some slippage in some of the decision-making because people are waiting a bit to see what's happening around interest rate, around the economy, and this can make some of the program decision-making slip by 1 month, 2 months, 3 months, and this is what we see currently at the beginning of the year.
Okay, that's interesting. So you are seeing some slippage, there is some concern, there is some conservatism coming through from your clients. What is that doing then to orders and sales? Again, as you look towards the end of the year, what are you seeing in terms of that demand for sales and orders?
So, you know, the end of the year was very good. So our sales were very strong. We had a book-to-bill of 1.16, which is basically a pretty strong one. So we're coming into 2023 with a good traction. But what we'll still have to look at is that traction across the year, and especially what happens around H2. And this is where, for the moment, we're going to be a bit conservative because we're waiting to see basically how decision-making for clients on some of the projects in H1 is going to take place. But we remain quite positive around the fact that there is definitely growth in the market. Our strategy and transformation business is doing extremely well, which shows very high client intention in terms of, you know, driving big transformation. What we're looking at is some slippage, you know, on some of the decision-making based on some of the uncertainty that our clients will see in terms of the macro for this year.
Is that the biggest risk? What do you see as the biggest risk in the next 3 months?
That's, for me, is the biggest risk is basic because the intentions are there. You know, the client have to do that transition toward a more digital and sustainable economy. So that transition is happening. It's changing the rules of the game, how they operate, how they innovate, you know, how they interact with their customers. All that is basically driving work for us across the value chain of clients. So the demand is there. The question is the timing of some of that demand becoming concrete, and that's where the macro plays. You know, I think as soon as we'll see more visibility around when the interest rate will stop increasing, that will probably accelerate some of the decision-making. So we remain quite positive on the outlook for the year.
And in terms of wages, in terms of labor costs, do you expect the kind of elevated wages that we saw last year to continue into 2023? How are you adjusting to that prospect? And what is the impact on margins?
So here we have two different things. I think last year it was a lot more driven by the tightness around the market in terms of technology. You know, there was very high demand with limited supply. We don't see that anymore. We have a market which is, you know, more fluid. We have more balance between supply and demand. Of course, in some high-end skills, you will still have some shortages. So the pressure coming from the tightness of the market is less. However, there is the salary inflation. We are a talent business, so we have to take that into account, you know, as we address our employees in terms of, you know, salary increases for 2023 is factoring this inflation in. So overall, we'll see a labor market that will be much less tight than last year. So the environment remains positive in terms of talent. The talent market might become tight again in a few quarters, but for the moment, we're extremely well positioned and quite attractive from that perspective.
And what is your ability to raise prices?
We still have ability, you know, the question is around the value you create for client. There's always potential for price increase if you deliver value. If you're more in the commodity side, of course, there might be more price pressure this year with the market becoming a bit tighter in terms of growth. But we're focusing really around the value creation for clients coming from the strategic transformation. And whenever you do that, you can create more value, and there's always potential for further price increase.
You touched on this, but where do you think we are in terms of the slowdown in big tech and in terms of the job losses that we've seen? Where are we in that cycle?
Yeah, so here it's quite contrasted, and I don't think we should have like one big thing around big tech, because we are in services, there's hardware, there's software, there's other component of tech. And I think not every company has reacted the same way, because if you look at some of these large companies in the US which have done layoffs, remember that their headcount increase has been quite significant over the last 2 years, and maybe they have over-anticipated some of the growth. We have been a bit more cautious from that perspective and trying to make sure that we don't over-anticipate the growth and try to more balance our talent. So I think from some of the cuts that we have seen, I think we're pretty much at the end of it from the big tech, at least from my perspective. I mean, for us, we are quite equilibrated in terms of our staff, so we're quite comfortable. I think there is some slowdown this year, definitely in terms of growth, but it's still good growth. I mean, we have to put things in perspective, and that will continue over the coming years. But there is some slowdown this year, definitely to factor.
Been a lot of buzz around some of these AI tools like ChatGPT. How do you expect that kind of artificial intelligence to impact your business and your customers?
So it's always, people can see it as threat and opportunities as any change that we see from a technology perspective. First, this goes under all what we call generative AI. It is not new. We have been working on that for several years now. The question is, how do you embed that in terms of application to real use cases for clients? I think the difference compared to what we have seen 2 or 3 years ago is that today you have some of this open to public kind of platform which allow people to try to see what is really this generative AI and what you can do with them. But we have been looking at them and trying to embed them in some of our solutions now for a number of years. I think as technology progresses, there's a potential to be able to accelerate, and we see it always in the positive way about how can we help accelerate our clients in terms of transformation. The same thing, you have a shortage in the talent market around coding to move to the digital economy. For us, if generative AI can really help accelerate some of the coding, that will help in terms of addressing some of the talent shortages we see in the market. So we think there is a positive impact that we can take advantage of, and the client can take advantage of in the coming years.
Really, really interesting. Capgemini CEO Aiman Ezzat, thank you very much. It was a beat on the earnings. The stock just off 0.3%, listed in France. Thank you for your time. Let's check in on some of the moves. I have to start with Credit Suisse. This is a redhead crossing the terminal right now. Credit Suisse shares dropping 4.3% to an intraday record low. An intraday record low for Credit Suisse shares, currently trading at 2.65 Swiss francs, down more than 4% just in the session today. Here's what's happening. Reuters reporting, I'm just going to pull up the story. Reuters reporting that regulators in Switzerland are probing comments by the Credit Suisse chairman to Bloomberg, Mr. Axel Lehmann, when he said in December about outflows that they had stabilized. And again, Reuters reporting that Switzerland's financial regulator is reviewing those comments by the Credit Suisse chairman, Axel Lehmann. They were made in December, and they were made to Bloomberg. He commented on outflows from the company, and he suggested that they had stabilized. Again, that stock down more than 4%, currently trading Credit Suisse at 264, currently down 4.7%. We'll keep across this story for you. It is another remarkable turn for this embattled Swiss lender. Another corporate that we're going to bring to your attention, BHP Group. We're going to be hearing from one of their executives shortly. Currently down 2.5%. It was a miss on the earnings. They are hoping that things are going to turn around in terms of the demand picture once they conclude the sale of their Canadian business, currently down 1.3% for HSBC. Coming up, a year of war in Ukraine has roiled the energy markets. We continue our special coverage recapping the impact of 1 year of war and how Europe was able to cut its dependence so quickly on Russian energy. That is next. This is Bloomberg.
does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We have seen the big two policy shifts recently around zero COVID and some more pro-growth policies being put in place for the property sector. That's been backed up by some pretty firm statements from the government there that are pro-growth for the year ahead. And very importantly, we're seeing the green shoots come through since the start of this calendar year.
That was Mike Henry, BHP CEO. The world's biggest miner posted its lowest half-year profit since 2021, but said it was optimistic about a demand recovery in China. Now, since Russia's invasion of Ukraine, Europe has been hit with a massive energy bill, of course, amounting to roughly $1 trillion last year. Joining us now is Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. Will, we got through this winter. Where do we stand now as we look to the end of 2023?
I think the first thing to say is if you look at the last year, we're probably in a better place than anyone has expected. If you think back to March last year, oil was at $140 a barrel. We're back below 85 today. If you look at last August, gas in Europe was an astonishing 300 euros a megawatt hour, the equivalent of more than $400 a barrel. We're back down to 50. Still expensive, but manageable. And we have, as you say, got through this winter in a fairly good place. At the moment, Russia's plan to squeeze Europe using energy failed. Next winter, well, look, a lot will depend on the weather. We were very lucky this year that it was a warm, mild weather and we had enough gas just to get it through with a lot of pain. If we had a cold winter next winter, it could get difficult again. The world is short of LNG capacity, given that Europe isn't buying any Russian gas through a pipeline, or very little, and won't be buying the same volume again anytime soon. So Europe needs LNG. That LNG was available. Going back to Mike Henry, the problem that we may have is China. Clearly, the other way we're lucky beyond weather is that China didn't have the gas demand, didn't have the oil demand, and people now seem to be quite optimistic about that demand coming back, and that could really tighten energy markets as we get through to next winter.
So those flows could be redirected back to Asia as China comes back on board. And you mentioned Russia and their bet that they could squeeze Europe, and you say, of course, that they ultimately failed to do that. And then, of course, the Western response to Russia with the sanctions. Have the sanctions worked?
It depends what you mean by worked. I think that clearly Russia is exporting a huge amount of energy, and what it has managed to do, gas, I think, is a problem for Russia. It's not getting much gas to market, but oil is a very different story. The big story about oil markets over last year is this massive diversion of Russian crude, Russian fuel to Asia. We reported today that China is importing record amounts of Russian oil, and that's kept the market well supplied. Russian production, after dipping immediately after the war was at almost near record levels in recent months, although they're going to cut it a bit going forward. So in that sense, the sanctions haven't worked. But I think it's important to remember that when we were in the midst of the crunch last year, it became clear that American policy was directed towards keeping oil flowing. They couldn't afford to see oil prices get into the high three figures, so they designed this price cap which allowed oil to keep flowing and tried to restrain the flow of dollars into the Kremlin. Has that worked? Perhaps to some extent. I think that revenues have fallen for the Russian treasury, but it's not been quite as painful as for Russia as people might have expected a year ago.
So going back to the prospects for next year and where the continent, where Europe gets its gas from, Russia isn't going to be supplying, of course, and that is by design. What happens? Where are they getting it? Is it Qatar? Is it the US who steps up to fill those inventories?
Well, it's the US that stepped up. I mean, we got through this through a flow of tankers from the US Gulf filled with US shale gas coming to ports in Western Europe, and that's really been what saved Europe from a much worse energy crisis this winter. Those tankers will keep coming. Gas prices in the US are very low right now. That arbitrage is still very profitable for people, but we remain constrained by the amount of liquefaction export capacity in the US. We can't get all the gas we'd want from America to Europe, and as I said, other people want gas too, and if China's gas demand comes back in a meaningful way, demand for LNG globally, gas that's turned into liquid to put on tankers, will again start to outstrip supply, and costs could rise markedly.
Okay, so still a lot of uncertainty in terms of the prospects for energy prices in the 6 to 12 months ahead. Bloomberg's Will Kennedy, thank you very much indeed, and do check out the reporting on this 1 year on, of course, from the conflict and the impacts across Europe's energy space. Checking in on Credit Suisse right now. This is a stock firmly in focus, down more than 5%. 5.2% is the drop on Credit Suisse, reporting from Reuters that regulators in Switzerland are probing comments by the chairman back in December, where he talked about outflows having stabilized from the company. Again, that stock taking a massive hit, currently trading at 2.62 Swiss francs, down more than 5% in today's session. We'll keep across this story for you. More broadly, across these European equity markets, it is firmly risk-off. Drop of 0.8% across the European benchmark. US markets also taking a strong leg lower. The futures down 0.9% on the S&P E-minis after President's Day, and markets closed yesterday. Nasdaq futures now down more than 1.2%. Yields higher. The dollar is bid. Yields higher by 5 basis points at the belly of the curve on the 5-year, and the dollar up currently 0.2%. Coming up, fancy a 4-day work week? Well, a new UK study shows your employer may be ready to oblige. We will bring you the details next, what it does for productivity. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, you know, there's 100 companies Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come on. So that's the package that you're talking about mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, you know, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third now 4% of new cars are electric. So that's the field that we're furthest along. About 4% of energy generation is wind and solar.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Welcome back to the Open. 54 minutes into the European trading day. Sharply risk-off across these equity markets, down 0.8% across the benchmark. Every single sector here in Europe in the red, bar utilities. Futures in the US pointing lower. The S&P E-minis by 0.9%. You're seeing losses of more than 1% over in Italy. The CAC 40 close to 1% lower as well. The yields up, dollar bid. Now let's get back to an intriguing and tantalizing prospect. 1/3 of companies participating in the world's largest ever trial of the 4-day work week are apparently ready to permanently switch their work patterns. The study involves 61 organizations and about 2,900 workers here in the UK between June and December of 2022. Joining us now is Bloomberg's Irina Angel. Irina, tell us more about the study, some of the key takeaways. What jumped out for me is it's not a surprise, of course, that employees are happy about the ideas of a 4-day working week, but the employers themselves also seem to back this.
Indeed, Tom, this study kind of makes the business case, for the 4-day work week. Organizations, they reported gains in revenue and productivity, and I think most importantly, they said it helped cut turnover in half, and it boosted recruitment, which obviously is very interesting, in a tight labor market. A third of organizations are ready to make that change permanent, but most of them, they said they want to continue anyway and decide later down the line if they want to make it permanent or not. And these results are even more interesting when you take into account, that the model was trialed in a very challenging time of economic time for the UK. It was the second half of last year. As counterintuitive as this may seem, it did convince people and companies that it's good for them, to work less, even in an economic crisis.
Okay, it's really fascinating. We'll see if it takes hold and gains more traction. The benefits for both employees and employers of the 4-day working week. Irina Angel, thank you very much. Indeed, we need to get back to these markets and specifically the Credit Suisse story. That stock down now 5.3%. This is on reports from Reuters that regulators in Switzerland are probing comments made by Credit Suisse's chairman back in December around outflows from the business having stabilized. We're going to bring you more details on this story in the next hour, but it is worth pointing out that the stock is taking a significant hit again in the session today. Across the broader markets, risk off firmly across these European benchmarks, down 0.9%. Losses of more than 1% over on the DAX in Germany. Futures also sharply lower in the US, down by 0.9% on the S&P E-minis. Yields are up 5 basis points on the 5-year, 466 on the 2-year. That's a move higher by 4 basis points. The dollar is gaining again, up 0.2%. Plenty more coming up. Surveillance early edition is next. This is Bloomberg.
I've always been a person who's just been attracted to hair.
I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, and here's what's coming up on today's programme. Credit Suisse shares fell to an intraday record low after Reuters reported Switzerland's financial regulator is reviewing comments made by Chairman Axel Lehmann to Bloomberg in December, when he said outflows had stabilized. The Russian President Vladimir Putin is set to give his State of the Nation address this hour after cancelling last year's event. We will bring you the speech live from Moscow. Also on the show.
What I'm really pleased of 3 years later is a radical change in the profit generation by geography. The Middle East alone last year generated 1.8 billion of adjusted pre-tax profits. Our troubled market in Europe 3 years ago produced an adjusted pre-tax profit of $2 billion.
HSBC considers a special payout after pre-tax profit jumps 92% in the fourth quarter. The bank also cut its bonus pool. Shares in London drop. Let's check in on these markets. Firmly risk off this Tuesday morning as investors weigh up the prospects of further rate hikes from these central banks. Goldman Sachs making calls on both the ECB and the Fed. A further 75 basis points for the Fed. That is call from Jan Hatzius. When it comes to the ECB, the team at Goldman Sachs expect another 250 basis points to get to a terminal rate at 3.5%. The data coming through as well is a very mixed picture that we've seen from France and Germany. The manufacturing sectors for both of those nations in contractionary territory. Services, though, performing quite strongly. And here's the euro area Feb print then for services PMI, rising to 53. The forecasts of 51. So firmly in expansionary territory in terms of euro area services for the month of February. Let's get back to a key corporate story for us today then. Credit Suisse shares have slumped to an intraday record low. That's after Reuters reported that Switzerland's financial regulator is reviewing comments that Credit Suisse's chairman Axel Lehmann made about outflows in an interview with Bloomberg in December. Here's what he had to say.
Putin thought Ukraine was weak and the West was divided. As you know, Mr. President, I said to you in the beginning, he's counting on us not sticking together. He was counting on the inability to keep NATO united. He was counting on us not to be able to bring in others.
Obviously, that was the US President Joe Biden, not the chairman of Credit Suisse. We'll bring you the correct soundbite from the Credit Suisse chairman, where he talked to Francine Lacqua about outflows at the bank having stabilized. It is an important story, and the stock is taking a major hit. Credit Suisse and the regulator, by the way, declining to comment. We're going to bring you the details. Let's see if we can bring you that important soundbite. This was the chairman of Credit Suisse speaking to Francine Lacqua of Bloomberg back in December about outflows. Listen in.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Now, both the regulators in Switzerland and Credit Suisse themselves have declined to comment. But this is a Reuters report that specific comment from the chairman of Credit Suisse to Francine Lacqua of Bloomberg back in December is now being probed by the Swiss regulators. Again, this is Reuters reporting. We will keep across this story for you as the stock takes a major hit. Let's get back to the geopolitics of the moment then. President Putin is giving his annual speech to the Russian Federal Assembly today. We are going to turn to the US and Ukraine first. President Biden pledging more military aid to help Ukraine fight back against Moscow. The Defense Department saying a $460 million package will include artillery and radar system. While meeting President Zelensky on an unannounced visit to Kyiv, Biden also promised further sanctions on people and companies assisting the Russian war effort. Joining us now to discuss this is our Warsaw Bureau Chief, Piotr Skolimowski. Piotr, what is the significance of Biden's visit to Warsaw today? The speech that he's expected to give, what are we going to be listening out for?
Indeed, it's going to be a major speech. Biden is coming back to Warsaw after being here in March, following the outbreak of the war. And obviously, what he is expected to say, or what Poles are expecting to hear from him, is essentially two things. One is that the U.S. is here for the long haul, so that it's going to provide support for Poland and for its other NATO allies. But also, and that's probably what Biden is going to also say, kind of echoing what he told Zelensky, is that the West is united. I mean, the expectation was the war will split the West. Instead, the NATO seems to be united, and that's the message that Biden is going to send. And it's important because Poland, first of all, is an important ally, but also it's became the hub for the delivery of various weapons. About 70% of all the weapons that are going through to Ukraine from NATO allies are coming through Poland. So it's an important hub. It's also sending its own weapons, but it's also in a vulnerable geopolitical place generally. So it expects some reassurances, and that's something that we're going to listen in for.
Okay, Bloomberg's Piotr Skolimowski in Poland. Thank you for previewing that speech. Of course, Joe Biden, the US president, expecting later today. For now, though, we cross over to Moscow, where the Russian president, Vladimir Putin, is addressing both houses of parliament, plus military commanders and soldiers. You can listen in. We will listen in now to the Russian president.
Our historical land to provide security and safety of our country, and to get rid of the danger from the neo-Nazi regime that established itself after the coup d'etat in 2014. We took the decision to start the special military operation step by step. Consistently, we're going to solve the problems that we're facing, starting as of 2014. Donbass defended its right to live in its own country and speak its own language. They fought. They did not surrender in conditions of blockade and continuous shellings from the Kiev regime. And they hoped and they believed that Russia will come and help them. In the meantime, and you know that very well, we did absolutely everything we could. Everything we could, I reiterate, to solve this problem by peaceful means. And patiently, we took part in negotiations to get out of this very difficult conflict. But behind our backs, a completely different scenario was prepared. Western rulers and the strife for peace in Donbass became clear today. It was just blatant lies. They continued to close the eyes to political killings, reprisals, and torturing people of faith, and promoted Ukrainian neo-Nazis to continue their illegal fight in the Donbass. And then they set up nationalistic battalions, provided them with weapons. I would like to mention, particularly before the start of the special military operations, Kyiv started negotiating to receive heavy weapons and other military capabilities, including aircraft. They also tried to get hold of nuclear weapons. The US and NATO developed their military bases, secret bio-laboratories. They were preparing to use the theater of the future operations, and the Kiev regime, the enslaved Ukraine, was prepared for a big war. Today, they accepted publicly. They, without any shame, they're very proud of it. The Normandy format and the Munich agreement is all a joke. And when in Donbass blood was shed and Russia very genuinely wanted to save lives, they played against it and using poker language, cards that were marked in Iraq, Yugoslavia, Libya, Syria. They will never be able to whitewash themselves because the decency, the legal actions, this is not for them. They are so used to spit at the whole world. They also treat the people of their countries cynically by telling them lies, by telling them fables about looking for peace and adhering to UN Security Council decisions. And it was all unprincipled lies. We stand by our position that in a modern world there should not be a division between civilized countries or the so-called civilized countries and the others. We have to have an honest partnership without any aggressive notion, and we are open to constructive dialogue with the West. And we reiterated that Europe and the whole world requires undivided security. And for many years, we suggested to our partners to work on the implementation of this idea. And every single time we get a very unclear reaction and actions, the enlargement of NATO towards our borders, as well as setting up missile defense. And they decided to create the so-called umbrella of theater missile defense around our borders. And once again, I would like to reiterate, and you know it very well, not a single country in the world has so many military bases as the United States of America. There are hundreds of them. I reiterate, there are hundreds of these military bases all over the world. The whole planet is dotted with these military bases, and we witnessed how they left fundamental agreements, including the missiles of low and medium range. And they left all the peaceful agreements that were called to support peace and safety. And in December 2021, we officially sent the drafts of agreements on guarantees of security. It was a principal position on us, and what did we get? A direct refusal. And then it became absolutely clear that they have aggressive plans and they're not going to stop. They're going to implement these aggressive plans, and the threat increased by the day. And in 2022, everything was ready to start the bloody illegal operation in Donbass. In 2014, artillery, tanks, aircraft. We remember those pictures when Donetsk was bombed, and from air, and not only in Donetsk and other cities. 2015, again, they tried a direct attack on Donbass with the blockade, terror, and shellings of civilians. This all went against the appropriate resolutions and documents adopted by UN Security Council. Everyone turned a blind eye. And once again, I repeat, they are to blame for unleashing the war, and we are doing our best, our utmost, to stop the war.
Те, кто планировали новую атаку на Донецк, на Донбасс, на Lugansk, четко понимали, что
that started the new attack at Donbass, Lugansk, and Donetsk knew full well that the next strike would be at the Crimea and Sevastopol. We knew that, we understood that well. And currently in Kiev, they are speaking openly about it. They've opened their cards. We knew that very well anyway. We are defending people's life. We're defending our house, our home, and the West is aiming for unlimited power. They spent millions of dollars supporting the Kiev regime and aiding and abetting them. The OECD is spending for helping the poorest countries in the world for 2020 about $6 billion. That's clear, isn't it? 150 billion for the war, and for the poorest countries only 60. And the requirements are very clear. These countries have to obey. And all those talks about sustainable development, ecology, and fighting poverty, where did all of that go? Where did it go? And the money for the war, the flow of it does not decrease. They are supporting the coups in other countries around the world. They don't spare any expense for that. In Munich, there were constant allegations against Russia, and there is a picture that was done purely for everyone to forget what the so-called West has done over the last decades. It was them who let the genie out of the bottle, and millions of regions were plunged into chaos. Because of
okay, we're going to leave this speech right now. The Russian president, of course, Vladimir Putin, with his State of the Nation address, his State of the Nation speech. The Russian broadcasters are slotted in about 1 hour for this. It could go longer than that. We may or may not dip back into it. Of course, Vladimir Putin saying that Russia will continue its military operations in Ukraine. Let's bring in Bloomberg's Mark Champion, who knows this part of the world very well indeed. Mark, just your initial first thoughts on the back of what we've been hearing from the Russian president.
Well, in one sense, it's what we've been hearing for a very long time. And I think there are a couple of things to take away from it. The first is that he is very much setting up the war in Ukraine as for Russians, not as a war with Ukraine, but as a war with the West. You know, what began as a special military operation, almost a policing operation, it was just to settle a sort of local problem. He is now setting as an existential war against our house, he called it, our home, in order to engage Russians more with the war itself. And I think the second message you got in this first part of the speech was to the global south, to the non-West, where he was saying, look, the so-called West, as he said, they have this decades-long pattern of militarism, and they are now spending $150 billion on a war, and they're spending just $60 billion on you. So all of their rhetoric about inclusion, equality, aid it's all nonsense, they're all about war. So those two messages, really, one for Russians to engage them in the war, and the other to the global south to say, the West are not your friends, we are with you.
Is he succeeding with the domestic audience? Is he succeeding in winning over support? What do we know about how much support there is domestically in Russia?
Well, I mean, the important thing is that there is almost no opposition. So whatever success he's having in persuading Russians of, exactly what he's saying, it's certainly been enough. He has full control over the media, over the, the non-social media, the non-sort of anything that is broadcast, anything that is written. He has full control, and there's really very little sign of opposition. There are signs that that the support for the war is soft, especially when it comes to the mobilizations. There was a lot of concern around the first mobilization, but he managed to do it. He got 300,000 people mobilized. If he has to do it again, these are the kinds of things he needs to say.
It's pretty remarkable, given the hit to the economy, given the fact that hundreds of thousands of Russian troops and those who have been mobilized are now being killed or injured. It's remarkable that he's not facing more of a backlash, at least on one level.
Yes. There are two possibilities here. One is that it's early days. It takes time for the sort of full knowledge and realization of A, the level of casualties, B, the fact that the war is being lost. And if that, if that is a narrative that it really takes hold, then that support may disappear. But in the meantime, the economy is not in worse shape than it was in recent memory. In the 1990s, and so for Russians, they are able to endure a lot that perhaps in the West.
Do we expect him to remark on Biden's visit to Kyiv?
I would be surprised if he doesn't, but he may just want to make this a story that isn't really about personalities in the West and so on. That he wants to just sort of stick with his narrative, but we'll see.
Okay, Mark Champion, thank you very much indeed. Bloomberg's Mark Champion, of course, on the analysis of this speech that continues. The Russian president continued to speak. We'll dip back into that in the minutes ahead. You can keep following President Putin's speech on Live Go, on the terminal, pledging the Russian president to continue this conflict in Ukraine. Stay with us. This is Bloomberg.
Political, military, and economic sense. For decades, they were destroying Ukrainian
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, UK Prime Minister Rishi Sunak has been meeting MPs from his Conservative Party to win support for a post-Brexit trade deal on Northern Ireland. The outreach effort comes after months of negotiations with the European Union. Joining us now is Adam Blenford, Bloomberg Senior Editor. Adam, what do we know about the behind-the-scenes talks? How much progress has been made? Are we going to get a deal this week?
Morning, Tom. Lots of questions there.
Yeah.
The chances of a deal this week are looking a little slimmer than they were perhaps at the end of last week. Last week there was, shutter diplomacy, Sunak flying into Belfast, talking with parties over there. This week the focus seems to be in the early part of the week on his own party in Westminster, trying to do a bit of arm twisting yesterday with those Brexiteer MPs who have always sort of sided with the Unionists and resisted the Northern Ireland Protocol, which you remember was an issue a few years ago. This morning there's a cabinet meeting. Obviously, Home Secretary Suella Braverman, a veteran of the ERG, that hardline Eurosceptic group within the Tory party, she's got a voice there and is said to be unhappy with the shape of a potential deal. And then later on this afternoon, James Cleverly, the Foreign Secretary, who's been in the negotiations with the Northern Ireland Secretary, he's talking to rank and file backbench. So you've got a sort of triple action operation to try and win over. That's just the Conservative MPs.
Yeah, we haven't even gone to the Unionists.
And, last week there was a bit of outreach to the Unionists, but yesterday one of their leader, their chief whip in Westminster said there's a very long way to go and he couldn't see themselves signing up. So it's looking really complicated, even though all the desire and a lot of the messaging and mood music was that this was going to happen about now. So, it looks like something's been blown slightly off course, and Sunak has got to try and bring it back.
Right, really, really important for a Prime Minister who's trying to improve those ties with the European Union, even if he himself voted for Brexit initially. Adam Blenford, thank you for getting us up to speed on that potential deal. Coming up, as the Russian president addresses the nation 1 year after that invasion, what do the coming months hold for Ukraine? We will bring you that analysis with S&P Global, the geopolitics front and center. Stay with us. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
it means they have a Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back. Credit Suisse shares falling to an intraday record low after Reuters reports Switzerland's financial regulator is reviewing comments made by Chairman Axel Lehmann to Bloomberg in December when he said outflows had stabilized. President Vladimir Putin issues a defiant message on his war in Ukraine, vowing to continue the invasion until Russia has achieved its goals. Also on the show,
what I'm really pleased of 3 years later is a radical change in the profit generation by geography. The Middle East alone last year generated 1.8 billion of adjusted pre-tax profits. Our troubled market in Europe 3 years ago produced an adjusted pre-tax profit of $2 billion.
HSBC considers a special payout after pre-tax profit jumps 92% in the fourth quarter. The bank also cut its bonus pool. Shares in London drop. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. The key corporate story of the moment, once again back in the headlines, is Credit Suisse. Shares, as we mentioned in the headlines, slumping to an intraday record low. You're now seeing losses of 4.6%, trading at 2.64 Swiss francs. Again, that's after Reuters reported that Switzerland's financial regulator is reviewing comments that Credit Suisse chairman Axel Lehmann made about outflows in an interview with Bloomberg in December. Here's what he said at the time.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Credit Suisse and the regulator declined to comment on these reports. We will bring you more on that story as soon as we have it. We are getting data across from the Eurozone, but also here in the UK as well. A redhead across the terminal. February services PMI rising pretty robustly to 53.3. The forecast was for 49.2. So UK February services PMI firmly in expansionary territory, 53.3. Manufacturing PMI actually coming in above the forecasts, 49.2. Still in contractionary territory by a slim margin. The forecast was 47.5, but manufacturing actually improving here in the UK. For the month of February, at least, according to these PMIs, 49.2, still in contractionary territory, but better than the forecasts. Services coming in strongly, 53.3. We're looking at the pound. Let me just check in on the pound on the back of this data. Currently 120, a little bit of a move higher for the pound, 120. And of course, how this plays in to the decision-making of the Bank of England come March. And that next decision, of course, will be crucial. A debate as whether they hike again or pause, given what is happening in this economy. 120 just turning up now for the pound on the back of this data. A little bit of a gain for the British currency. Right, let's get back down to what is happening with Russia and Ukraine. The Russian President Vladimir Putin has kicked off a speech to the Federal Assembly just days before the country marks 1 year since it invaded Ukraine. It comes as President Biden pledged more military aid to Ukraine during yesterday's unannounced visit to Kyiv. The US president also promised further sanctions on people and companies assisting the Russian war effort. We are now joined by S&P Global Head of Geopolitical Thought Leadership, Lindsay Newman. Lindsay, good morning. Thank you for joining us. Let's get your take then on what we've been hearing so far from the Russian president committing, it's not surprising, to continuing this war in Ukraine. Where do you think he goes from here?
Thanks, Tom, again for having me on. Through its invasion of Ukraine a year ago, Russia has really written a smaller role for itself in the global economy, and Putin knows this. These are going to be lasting trends. If we look at the data, Russia's economy contracted in 2022. We forecast in market intelligence that it's going to contract again in 2023. Revenue's down, trade in good and services is down, but inflation is up, and the fiscal deficit is up. And this is all based on Russia's own data. So Putin is telling a story today of a conflict that he remains very committed to.
He remains committed, and on the ground, in terms of the military action, there is speculation around a spring offensive, some saying that may already have started. What do we know about the military conflict unfolding in the Donbass region and in Ukraine more broadly?
You're absolutely correct. Question is whether that counteroffensive has already begun in the east, in Donbass. If not, it will certainly begin imminently, and we're expecting Ukraine to really focus its efforts. While it wants to continue to focus in both the south and the east, it's going to need to counter that counteroffensive from Russia in the east. And a key question for Ukraine is whether they're going to continue to secure that support, the military assets, the supplies that they're asking for, this escalatory list of supplies that they're asking for, which is why, in part, Biden was in Kiev yesterday and will continue to present a message of unity today when he speaks in Poland.
Yeah, talk to us about that visit then, the surprise, the unannounced visit to Kyiv. Was it more than just a photo op, Lindsay? Is it more than just a morale boost for the Ukrainians?
We have to remember, when Russia invaded Ukraine on 24th Feb last year, the transatlantic relationship was really in an uncertain place. You know, it was just the turn of the decade when we were hearing about NATO's brain death, when we had successive U.S. administrations calling on Europe to pay its dues, to support its collective defense. And a key trend from the last year, which, as Putin has said today, is that was perhaps underappreciated, was the unity that we saw both within Europe and between the U.S. and Europe. And the key question as we look to the second year is, will that unity continue? And Biden brought a message yesterday of saying that U.S. is in it for as long as it takes. That's how he wrapped up his remarks yesterday. The U.S. is committed to Ukraine for as long as it takes, announcing an additional $500 million in military aid and previewing potential additional sanctions on individuals and entities seen as enabling Russia to evade sanctions. We expect more similar rhetoric today in the announcement today, but we have to be aware that there are countercurrents, right? We have a U.S. domestic audience watching this closely. There is indication from some polling that the commitment to Ukraine is perhaps slipping off of those peak numbers from a year ago. We have a new Congress in the U.S. We have a debt ceiling concern, not our baseline scenario, but these are all factors that are at play. And Biden wanted to bring a clear message of unity yesterday, and he'll continue that today.
Is that so on that point around unity, the coalition that's been formed to counter Russia, where are you looking for potential frays, for potential cracks in that unity? Is it the domestic politics of the U.S.? Is that what is most vulnerable at this point?
There is a vulnerability there. There seems to be bipartisan support remaining quite strong, but on both sides of the aisles, it's sort of there are pockets of questioning around. We've seen around whether there should be a blank check. There's certainly questions about the type of military assets that are going to be available for Ukraine. President Zelensky asking for fighter jets and for long-range missiles. The U.S. has thus far been quite hesitant to provide that to that theater because of the potential knock-on implications. But this issue of unity really on the sort of U.S. and Western European side has been quite robust. Interesting to watch what we're seeing elsewhere, and Putin sort of mentioning, sort of egging it on today with his comments about the global South. The world that we're living in, the way that we're seeing it is fluid and flexible, in which countries are cooperating across certain spheres and competing elsewhere across other spheres. It's really a pragmatic approach. So that opens the door for sort of both sides of interaction.
Yeah. Lindsay, what is the U.S. response if China does supply weapons to Russia?
The question here is, as I was just saying earlier, is how does the U.S. respond to any country pursuing additional sort of overt support for Russia. And what that ties into is how we're seeing now this interplay, this accelerating interplay between economic and security spheres. In some ways, we're watching a new world, a new war, a new form of conflict unfold before us. It's a social media exposed conflict, but it's also, if we think about how the U.S. is really leading on the global security side of it, this is not a boots on the ground conflict that the U.S. is engaged with. It's a dual strategy of providing massive aid and military resources while also leveraging economic tools like sanctions. So we can certainly expect to see, and as I said already, Biden is expected to announce additional sanctions just this week. And that, those economic tools of national security, those economic tools of statecraft is really where we should be falling.
Okay, so we'll be watching to see whether or not those economic tools are used against China, if indeed they do start supplying weapons, and it's still a big if, to Russia. Lindsay Newman, smart analysis. Thank you. S&P Global Head of Geopolitical Thought Leadership. Thank you for joining us. Now, Russian exports of discounted crude and fuel oil to China, staying on that story, have jumped to record levels. That's as the reopening of the world's biggest energy importer gathers pace after the dismantling of COVID-0. While benchmark Brent futures are lower year to date, driven by concerns about tighter US monetary policy. There is that pull and tug between the two factors. Joining us now is Bloomberg's Senior Executive Editor for Energy and Commodities, Will Kennedy. Will, is this latest data on Russian flows to Asia the marker of an inflection point or something of a one-off?
I doubt that it's a one-off. I think it points to a broader trend, which you alluded to in your words there, which is that China is clearly opening up. I think people are starting to see signs that demand for commodities in general, and oil in particular, is recovering fast, that the economy will suck up more crude and need more fuel. And clearly it's sourcing a lot of its crude from China, and there's been this great reordering in the global energy system, which has seen Russian oil that previously went to European refineries go to India and China in particular. And I think that's a trend we will see. Whether it will continue to grow, I think perhaps is open to debate, because Russia has said that oil production will fall by 500,000 barrels a day. But Chinese demand for Russian oil, China using Russian oil in its refineries in a way that it didn't previously, I think is a new fact to the global oil market.
To what extent does China offset the damage from sanctions then? Have we seen a material impact from sanctions, and will it change?
For Russia, the impact has actually not been huge on the oil industry so far. One of the surprising things about the last year since the war started is I think that people felt that sanctions could have an impact on oil production. One, because Europe would not be buying as much oil, and two, because some of the sanctions on imports might affect the ability of the industry to keep going. Neither of those things have actually happened. As we said, Russian crude has largely been diverted to buyers in Asia, and the industry has done a fantastic job of keeping going. They've drilled, we reported last week, as much as they ever have, and production was pretty close to all-time highs for a lot of last year. Now, that's going to fall by 500,000 barrels a day, the Russians say. There's some debate about whether that's a voluntary choice or an admission that they can't keep going at the same pace. But I think people have been surprised by how resilient the Russian oil industry has been.
All of that then tying into future prices, and I'm not going to press you to give us a forecast on pricing, but Goldman Sachs, Jeff Currie coming out and just reiterating his bullish call on commodities and energy. They've set themselves a forecast of plus $100 by the end of the second half of this year. Is that becoming more consensus?
There's definitely an idea out there that the oil market should tighten in the second half of 23. You put together the fact that OPEC has said that it's not going to increase production this year, that Russian production is going to fall a little bit, that shale continues to disappoint on its production growth, and you've got a pretty muted supply picture against a pretty strong demand picture, which may get significantly stronger as the Chinese economy reopens and grows and people start flying again. You talked about the Fed. Clearly they're grappling with an economy that is stronger than some people expected. So that picture is definitely there for a lot of analysts, that you're going to see demand outstrip supply in the second half, and that could be constructive for prices.
Okay, $83 a barrel on Brent, $76 a barrel on WTI, just 0.1% lower for WTI in the session today. Bloomberg's Senior Executive Editor for Energy and Commodities, Will Kennedy. Thank you for the latest. Now, coming up, Credit Suisse shares hit a record low on a Reuters report of a probe into claims the lender's chairman made about outflows to Bloomberg. We've got the details next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings season continues.
The chips are down.
Earnings coming in fast and thick.
A slew of bank earnings this morning.
Bloomberg breaks the numbers first.
Numbers coming through from Shell.
LVMH numbers are hitting the tape right now.
We had a very good set of numbers in the fourth quarter.
We feel confident with the guidance we've given.
The situation has changed completely.
With exclusive expert analysis.
Europe's most valuable company. Trending towards the higher end of its historical range.
I can continue. How do I play this into 2023?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back. Another grim day for Credit Suisse. Shares slumping to an intraday record low. That's after Reuters reported that Switzerland's financial regulator is reviewing comments Credit Suisse's chairman, Axel Lehmann, made about outflows in an interview with Bloomberg in December. Here's what he said at the time.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Outflows basically have stopped. That's the key line from that interview in December between the chairman of Credit Suisse and Bloomberg's Francine Lacqua. Credit Suisse and the regulator, FINMA, declined to comment. We will bring you more on that story, of course, as soon as we have it. In terms of the market reaction, though, let's bring in our equities reporter, Joe Easton. And Joe, I was talking about the fact that you have to really give up on the number of days where this stock has taken a hit and how brutal it's been over the last 12 to 24 months for Credit Suisse, and another severe leg lower for this stock.
That's right. It's been pretty rough, as you say. I mean, if you think about back to a year ago, it was trading at around $10 when you convert it from the Swiss francs. It's now down to around 2. Intraday record lows we had on the screen
on a dollar basis.
in a year on a dollar basis, which is pretty disastrous, really. And it kind of makes sense given that, obviously, the outflows from the wealth management division, but then this report is pretty damaging given that there was a capital raise after those comments. So the reason you would buy into that capital raise is potentially because you believe the wealth management outflows are going to stop. And if that hasn't been the case, then you'd question why were they buying into that capital raise, and now they're facing more losses from the stock hitting an intraday low. So it's pretty bad.
And it was a successful capital raise. And again, to stress, we're still waiting for comments from the regulators over in Switzerland, but also Credit Suisse as well. And this is a report by Reuters, so we're waiting for more details. 263 now in terms of Swiss francs for Credit Suisse. How do you think investors, I mean, to your point, to draw it out a little bit more, Joe, how do you think investors are weighing this all up at this point?
Well, I think that, just to kind of reiterate, I do think that the main concern was always the wealth management outflows. The restructuring, away from the investment bank gave a kind of reason to buy into that story and say, we're going to refocus on the wealth management area, trim down some of the investment bank, narrow those divisions down. But if they haven't got a clear picture on the flows, then what are they investing in? How can you even give the stock a price target if you don't know where that money is going?
Does history tell us how these regulatory probes unfold in Switzerland? Do we have a steer on what they're going to be looking at specifically and how this may play out in the days and weeks ahead?
Well, I think that, as you mentioned, we have to wait and see how clear they are, the regulators, and how they take this. But I think that if obviously want to be careful on not speculating, but you have to consider how the management composition will look within the next 2 or 3 months, even 6 months, if this progresses. Is there a question over company direction? But again, it's a bit too early to speculate on that. I have to see what the regulators do. But the main concern, one of the other concerns, would be how the board looks 6 months from now, I would say.
Joe Easton, on the market reaction to this story, the reporting again from Reuters that regulators are probing some of those comments from the chairman of Credit Suisse made back in December to Bloomberg on outflows, and that stock currently down 5% on Credit Suisse. Okay, coming up, HSBC's UK shares trade lower, but CEO Noel Quinn tells Bloomberg he is upbeat on the bank's global business. It was a beat on the earnings. More from that interview next. This is Bloomberg.
Why'd you do this project? Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
News breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
This is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, HSBC is considering a special payout and new dividend issuance after the sale of assets in Canada and China. CEO Noel Quinn tells Bloomberg he is not overly concerned with performance in the UK. The stock trading up now, 1.4%, having closed in the red over in the Hong Kong session, gaining 1.4%. The CEO spoke to Manus Cranny earlier.
If you go back 3 years ago, as you'll know, we were very dependent on profit generation coming from two principal markets, Hong Kong and the UK, with a strong international banking franchise overlaying that with transaction banking and international wholesale banking. What I'm really pleased of 3 years later is a radical change in the profit generation by geography. The Middle East alone last year generated 1.8 billion of adjusted pre-tax profits. Our troubled market in Europe 3 years ago produced an adjusted pre-tax profit of $2 billion. Our US business, again troubled 3 years ago, produced an adjusted pre-tax profit of $1 billion. And even within Asia, we got good diversification. Outside of Hong Kong and China, we generated more than $4 billion of adjusted pre-tax profit in 2022. So that gives me a solid base of geographic profit generation, supported and overlaid with a strong international banking franchise and a market-leading transaction banking franchise. So that gives me confidence in our 2023 forecast. Now, to come to your point on net interest margin, our guidance on NII is 36 billion plus, in excess of 36 billion. We believe that we still have upside. Our NII in 2022 was 32.5 billion. We're guiding to in excess of 36 billion in 2023, so good growth. There are some uncertainties on the horizon, but we're still positive. We know where consensus is at the moment, and we think consensus is in a reasonable position. So we're not looking to change guidance on NII, and I think we're pretty confident we have a good prospect of delivering our return next year.
All right, from one banking story to a very different one now. Credit Suisse, the stock down 5.2% on reports by Reuters that regulators in Switzerland are probing comments made by the chairman to Bloomberg back in December. Meanwhile, the Russian President Vladimir Putin still addressing the nation there, saying he will continue this war in Ukraine. Stay with us. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Kyiv stands, and Ukraine stands. Democracy stands. The Americans stands with you, and the world stands with you.
I think we're at an inflection point. We have a moment. And for everyone who says we want Ukraine to win and Russia must fail, if you believe that, then act now.
A lot of risk, and the message is don't doubt our commitment to the people of Ukraine.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. President Biden's in Poland, where he hopes to rally new support for Ukraine's fight against Russia. Vladimir Putin delivers his first State of the Nation address in almost 2 years. The Russian leader issuing a defiant message, vowing to continue the invasion until Moscow has achieved its goals. And HSBC says it may pay a special dividend following a sale of its Canadian units. The bank's fourth quarter earnings almost doubled. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, plenty of geopolitics to go around today. We also have a lot of earnings stories to talk about here in Europe and data. We've had PMIs out of Europe, PMIs out of the US a little bit later on today.
Yeah, there's a lot going on again to kick off what is for us here in America a shortened week. Market's not exactly sure that they like what's going on. You can see that S&P futures down more than 0.5% right now. And at the same time, though, investors are selling 10-year debt. That means that the yield rises 386.70. That's getting near the top of its range, back again to the top of its range for the session. We had seen it come down a little bit earlier, but as the yield climbs, that offers more competition to the S&P yield, and as a result, it puts a bigger headwind on stocks. NYMEX crude is up, but still only at $76.66 a barrel. So a relatively low level there. At least we're not at 80 on NYMEX, and Brent isn't also higher. We have seen earlier in the session the oils trading down, although all of the other commodities, copper, iron ore, corn, all soybeans, all rising. So now oil has turned around and is rising with the rest of the commodities complex. Bitcoin also barely budging right now, but just shy of $25,000 once again after a strong weekend. So 24,787 shows that Bitcoin continues to rise. In terms of Asia, there's not a heck of a lot to look at, although we did have a pretty big drop on the Hang Seng. You can see the Hang Seng here down 1.7%. That's worse than many of the other indexes in the region. The MSCI Asia Pacific, the broader index, down but just about 0.8%, and the Nikkei down far less at the close, just 0.2%. I will point out that the U.S. dollar now buys 134 yen, so climbing in strength against the Japanese currency. We'll continue to keep our eyes out for action at the BOJ. Anna, what do you see in terms of Europe?
Yeah, in Europe then, Matt, we see weakness across European equity markets today. Down 0.2% in London, a little bit more than that, 0.4% down on the DAX and the CAC. So some weakness, and most sectors are actually in negative territory. Only some very defensive sectors seem to be doing better today. The likes of healthcare, for example, that's one of the sectors that hasn't been doing too badly. In terms of where we are on the individual stocks, though, BHP is worth a mention. This on the earnings story. We've got the BHP share price here in London down by 2.7%. The company reporting revenues that dropped. Dividends also being cut. China remains a focus for the recovery part of the story over at BHP, the big miner, global mining business, of course. Engie, a different story there, but again, about dividends. This is a business operating in the energy space in France that is able to make good profits at the moment. And so profits jumping and dividends going higher, and that stock up by more than 4%. And here we get to some really interesting response then, Matt, to the data coming out of Europe. We've seen disappointing data from Germany on the manufacturing side, and that seems to be the thing that's caught the imagination of those trading on this European data set. We also just got the ZEW numbers coming through from France. That, on the other hand, paints a slightly better picture, telling us the story that we already know, perhaps, which is around recovery in expectations on the German economy, rising to 28.1. The estimate was for 23. So that's the ZEW part of it. But the market focused on the disappointing manufacturing data in Germany, perhaps, and the euro goes a little bit lower. The pound, on the other hand, up by 0.3%. We're also seeing repricing in gilt markets after we got a composite PMI figure that surprisingly showed expansion in the UK economy. It came in at 53. It was the services side that was much better than had been anticipated in the UK. Does that mean then, Matt, that the Bank of England has to hike more times than had been anticipated? The market seems to be asking that question right now.
All right, similar questions across, I think, Western markets in terms of what's the central bank going to do. Let's get, though, back to geopolitics right now, because Russian President Vladimir Putin has been defiant in his first State of the Nation speech in nearly 2 years, reiterating that Moscow would continue to fight for its historic lands, his words, in Ukraine. Joining us now is Mark Champion, Bloomberg senior reporter for international affairs. So, Mark, what do we hear from Vladimir Putin? Is this the annual speech that can go on for hours and hours?
Well, you know, it's already gone on for an hour, but I mean, I think the essential, there are a few messages in there. It's very clear, actually. You know, the first one is we are gearing up for a long war. We will do what it takes. He talked about restructuring the economy. He talked about restructuring logistics to turn them east. He talked about also setting up institutions internally to deal with veterans, with the families of the fallen. And he was basically telling Russians that this is a good thing, that the economy is actually doing something healthy, something we should have done a long time ago. It's becoming more self-reliant, more resilient. There will be growth, there will be jobs. And so that was his message for home. Outside, he was really addressing the global south, if you like, and he was basically saying the West is full of hypocrisy. This is not our war. They forced it upon us. And when they say they want to give you aid, they're only giving you $60 billion, whereas they're spending $150 billion on the war, and that's all you need to know.
Okay, yeah, really interesting then. So they're in it for the long haul, seems to be one of the key messages, as you say, and self-reliance is a silver lining, I suppose, if you're cut off from certain other economies around the world. Mark, let me ask you also about what's happening with China and China's role here in this conflict in Ukraine, because Beijing seems to be looking to broker some sort of peace agreement here. A delegation, we understand, from China heading to Russia to present some ideas around that. What more do we know on this?
Well, we don't know a great deal, but it is, you know, that is potentially really important. What China does, what it chooses to do is critical. The U.S., China denies it, but the U.S. has said that they understand that the Chinese are considering arming Russia, which would be a real kind of carrot and stick, where you provide a peace deal, which it's highly unlikely is one that Ukraine or the West could accept. And on the other hand, your implicit threat is that if you don't accept this, we will arm Russia, and this war will become unwinnable.
Mark, thank you. Thanks very much for the analysis. Bloomberg's Mark Champion. We'll keep across, of course, all the news lines coming through from Russia as Putin continues to deliver that State of the Nation address. Now, President Biden is seeking dividends from his surprise trip to Ukraine. The president is hoping to rally new support for the Ukrainian efforts against Russia as he meets with Eastern European leaders in Poland. The U.S. ambassador to Poland spoke with Bloomberg's Anne-Marie Hordern on the symbolism of Biden's trip to Kyiv.
President Joe Biden quite bravely took a trip to Kiev, a lot of risk, and the message is don't doubt our commitment to the people of Ukraine.
Anne-Marie Hordern, Washington, Bloomberg's Washington correspondent, joins us now from Warsaw in Poland. Anne-Marie, so you holding those conversations yesterday. Yesterday we talked about President Biden's trip to Ukraine and what that meant. What is he hoping to get out of this dialogue today then as he's in Poland?
Well, on the heels of President Putin speaking in Moscow, you're going to see really split screen, a big version of a split screen between a war of words, really, between what President Putin is outlining and what President Biden is going to outline in just over 6 hours here in Warsaw, about 800 miles away from Moscow. He's going to be talking about this idea of democracies versus autocracies and how he sees that democracies are the ones that are going to outlast in this world order. And he's going to talk about what he talked about yesterday in central Kiev as he walked in that central square next to President Zelensky, this with unwavering support that the United States has for Kiev. And it comes at a time that there is this concern about fatigue setting in amongst the Western alliance. We are about to approach that 12-month mark of this war, and many leaders are setting in for a prolonged war. And Biden is here to say, we will stay with Ukraine until the very end. And that's really a show of support as well for the allies to make sure they continue to send support as well.
What do we know about the Chinese, though, AMH? Because it looks like they're considering arming Russia. We know the Chinese are meeting with the Russians at the same time as these meetings are happening in Poland. How does that figure into the equation?
Yeah, China's State Councilor Wang Yi, he met with Secretary Blinken over the weekend at the Munich Security Council, and now he's in Moscow. And he's likely going to be meeting with President Putin as President Putin, after he wraps up this speech, a very long one indeed. What China really is doing is, on the surface and in public, they are talking about the fact that they want to outline this peace plan. But behind the scenes, what you hear from U.S. officials is the fact that what they are doing is actually still continuing to aid Russia. And what Secretary of State Antony Blinken told CBS over the weekend is that they are seeing potentially these concerns of lethal military aid to Russia. So the United States is going to be, at this time when there's also a lot of acrimony between Beijing and Washington after the alleged Chinese spy balloon, they are going to be dealing with this potentially China that says one thing but does another.
Anne-Marie, thanks very much. Bloomberg's Anne-Marie Hordern reporting there from Warsaw in Poland. Now back to the corporate earnings stories. HSBC is considering a special payout and new dividend issuance after the sale of assets in Canada and in China. With fourth quarter earnings beating analyst estimates, the CEO, Noel Quinn, spoke exclusively to Bloomberg's Manus Cranny earlier.
What I'm really pleased of 3 years later is a radical change in the profit generation by geography. The Middle East alone last year generated 1.8 billion of adjusted pre-tax profits. Our troubled market in Europe 3 years ago produced an adjusted pre-tax profit of $2 billion.
Joining us now, Bloomberg's finance reporter Tom Metcalf. And something about this earnings story seems to be slowly dawning then, Tom, on investors, because the stock was trading down considerably weaker in London earlier, now up by 1.9%. I guess the focus now is on the return of cash to shareholders.
Yeah, exactly. Look, it was a decent set of results, and I think initially investors were a little bit sort of wary of the outlook, which, you could read as being pretty cautious. But we've got a few calls going on now. Analysts have just come off a call with Quinn and his CFO, and I think that kind of reassured the market. You've seen that shares jump on, a strong profit beat in the fourth quarter, and generally saying, look, we're happy with how things are going, and sort of things seem to be running quite well over there.
Credit Suisse shares have slumped to another intraday record low. That's after Reuters reported that Switzerland's financial regulator is reviewing comments that Chairman Axel Lehmann made about outflows in an interview with us back in December. Here's what he said then.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
So what do we know? What more do we know now about this probe, Tom?
Yeah, it's early days. I mean, basically Reuters were reporting that FINRA, the Swiss regulator, is effectively looking at those comments we've just heard. And you know, the nub of the issue appears to be effectively some months after he made those comments, those outflows did continue. And of course, in between that period, Credit Suisse was out there raising money. So very early days, not clear yet whether this will be a formal probe. It's just questions. But obviously Credit Suisse investors not liking the look of it.
All right, Tom, thanks very much. Bloomberg's Tom Metcalf talking to us about the banking news at HSBC as well as Credit Suisse. Watch those shares in markets today. In terms of what we're watching in the pre-markets, Stellantis is one of the stocks that could move. It's going to issue its earnings report tomorrow morning in Europe. So by the time many of you wake up, of course, Anna, you'll already be well awake, we could see these shares moving in the pre-market here as well as moving on the continent. Meta, Facebook, is another stock that could put up some big moves today. In the pre-market, it's up 2.25% after Mark Zuckerberg said the company would get even leaner, really focusing on keeping a lid on costs, boosting profit. The profitability portion of Facebook's lifetime is now in session, and as a result, you know, maybe we'll see moves that compete with the 20% move we saw a couple of weeks ago. Maybe not that high. Nonetheless, Manchester United, also, I guess, a stock. Is this a U.S. quote? Does it trade here? Or is it?
It does.
All right, so it's up 2.4% here on the possibility, of course, of a buyout. We've been talking about who could take over Man U from the Kingdom or possibly somewhere else if they get another bidder. As a result, 26.96. Is this based in the U.S.? Do we have a soccer team?
It listed in the U.S.
Trading in America?
It did. It listed in the U.S., which is sometimes why we find it hard to find a home for the story. But absolutely, it deserves its place in pre-market movers, Matt, because it is U.S. traded, which means the story we covered yesterday, which was all about Jim Ratcliffe's bid, a UK domestic billionaire, the owner of Ineos, of course, and the Qataris bidding, all of that. We haven't seen any movement on that story because U.S. markets were closed yesterday, so we'll look for that today.
And Jim Ratcliffe also maker of the Grenadier, which is an incredibly exciting Land Rover Defender-esque car. He came up with the idea in that pub in Belgravia.
Big fan of football, apparently, of the
who isn't?
Right. Yeah. Coming up, Pooja Kumra joins us, Senior European and UK Strategist at Toronto Dominion Bank. We'll talk about rates. How has her thinking been changed, if at all, by the PMI data we've had out of Europe today? Quite a lot to think about there. And as we approach 1 year of war in Ukraine, we will speak with PGIM's fixed income lead emerging markets economist, Magdalena Poland. That conversation shortly. Plus, cracks in the US war machine, perhaps. Today's Big Take story takes a look at America's military-industrial complex and why it may be misfiring. Look for that online or on the Bloomberg terminal. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller here in New York. Anna Edwards with us out of London. We're looking at an incredibly small premium in terms of the earnings yield on the S&P over U.S. debt. In this case, we use the 10-year yield, and it's only 1.26% away. But if you look at the 6-month yield in terms of T-bills, it's almost exactly the same as the S&P 500 earnings premium. So taking away that advantage that stocks may have over bonds. Joining us right now to talk a little bit more about this is Sagarika Jaisinghani, a Bloomberg equities reporter. So Sagarika, do we see less interest in stocks as yields climb ever higher?
Hi, Matt. Definitely. I think the mood on Wall Street has definitely soured, particularly since the hot inflation reports that we saw last week. And, you know, that's the big debate that's sort of brewing in stock markets since last week, which is how do you navigate this so-called no landing scenario, right, where you've got evidence that the U.S. economy remains resilient. At the same time, we've heard from several Fed policymakers that they see the need for interest rates to keep rising at the moment as inflationary pressures remain. And we've had a chorus of sort of strategists, most notably Michael Wilson at Morgan Stanley came out today and addressing, you know, the equity risk premium. He said it's actually the lowest now since 2007, which is definitely dulling the prospect of the rally continuing.
Okay, and let me ask you more about that no landing scenario, because it's a really fascinating one. On the one hand, you could see that as really risk off, because if there's no landing, inflation stays high and rates have to go higher, but markets don't seem to be interpreting it that way in the short term. They're managing to find some upside, some positivity in a no landing narrative.
Yeah, absolutely, and that's where the warning comes in. We've heard from several other strategists as well, both, JP Morgan's Mislav Mateshka came out and said that yesterday, that that bets on that sort of economic resilience as well as an imminent Fed pivot are still premature. So on the other hand, though, they don't see, the others aren't as pessimistic as Michael Wilson has been. He's calling for a 26% drop in the S&P 500 in a matter of months. The others are sort of saying that equity allocation, while it has picked up since last year, which was at a record low, it still remains below sort of the historical averages that we have seen. So they don't see immediate selling pressure on stocks, but they do see the rally fizzling out.
Sagarika, thank you very much. Thanks for joining us. Sagarika Jaisinghani with the latest on markets. And for more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal for the Markets Live blog. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep,
mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Turkey, a pair of earthquakes rocked a southeastern province 2 weeks after major quakes in the same area killed more than 40,000 people. Monday's quakes killed at least 3 people and injured more than 200 others. Turkey's government has announced that it will start building about 200,000 homes in the hardest hit areas. China is urging the world to stop saying that Taiwan is next after Ukraine. Foreign Minister King Gan says that certain countries should stop fueling the fire by blaming China and saying, quote, Ukraine today, Taiwan tomorrow. Beijing has been trying to distance itself from Russia and portray itself as a neutral force for peace. Results are in from the largest ever trial of the 4-day work week. It found that most British companies taking part are not returning to the 5-day standard. The study involved 61 organizations, about 2,900 workers. Overall, businesses saw revenue gains, drops in turnover, and lower levels of worker burnout. And, dear Lord, I hope that comes to us at some point, Anna.
Well, yeah, we wish you well with that one. We will talk about the markets when we come back. Pooja Kumra, Senior European and UK Strategist at Toronto Dominion Bank. That conversation shortly. This is Bloomberg.
What are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving, tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. President Biden's in Poland, where he hopes to rally new support for Ukraine's fight against Russia. Vladimir Putin delivers his first State of the Nation address in almost 2 years. The Russian leader issuing a defiant message, vowing to continue the invasion until Moscow has achieved its goals. And in corporate news, HSBC says it may pay a special dividend following the sale of its Canadian unit. The bank's fourth quarter earnings almost doubled. I'm Anna Edwards in London with Matt Miller in New York. And Matt, a lot going on in terms of the geopolitical stories that we're tracking in China, in Russia itself, in Ukraine, of course, and in Poland. So lots to talk about when it comes to geopolitics this week. A lot of data for the markets to digest, and something has clearly spooked equity markets.
Absolutely, and some big earnings, right? Don't forget we're going to get Walmart. So a huge read on the consumer today. Home Depot, I believe, coming out as well. So extra retail information coming out this morning before the bell, and that could be what has markets worried. Although you're right, obviously there's so much geopolitical information that it's difficult to get your head around. The S&P 500 futures continue to fall. So we're at session lows right now, down 0.7%. Meanwhile, the yield on the 10-year continues to rise, now at its highest level, 388. I'm going to say that's the highest level we've seen all year long. So a 2023 high on the U.S. 10-year yield as we approach just the end of February, just 2 months in. NYMEX crude coming up now about 1% to over $77 a barrel. It's interesting, when I first looked at the commodities page today, GLCO, crude was one of the only commodities down, and we had everything else from metals to ags gaining. But now we're all on the same page, and everything in commodities is rising. Bitcoin, well, it's unchanged right now, but 24,757 puts it near as damn it to 25,000, and that's after just an incredible run this weekend. So Bitcoin, the rally continues to be powered. Take a look at some of the pre-market movers that we have today. Stellantis is obviously a gigantic conglomeration of automakers that includes Dodge and Chrysler, as well as Fiat and Peugeot. It's down 2.3% right now. It comes out with earnings tomorrow. I love to scream Stella randomly in the newsroom at any time because the ticker is STLA. Meta Platforms is up 2% right now. This is, of course, Facebook, and it had this incredible 20% move like 2.5 weeks ago, but that was based on cost cutting and a move into a profitability phase of its career, and Mark Zuckerberg has talked more about that this weekend. So maybe we could see more moves to the upside. Manchester United, I may have known before, but I'm learning again that it's listed in the U.S. It is, of course, a soccer team, but it could be a $6 billion soccer team, so everyone's interested. From is it the Kuwaitis or the Emirates?
Qataris.
The Qataris are interested, apparently, and they already own PSG. I'm learning more about soccer this week than I've known for a long time. But also the guy who owns Ineos and created the Grenadier Land Rover Defender-like car may be interested. I'm not 100% sure what's going to happen there. In any case, Man U is a very popular team. And then Walmart coming out with earnings today, as I said, as well as Home Depot. We're watching very closely to see how the U.S. consumer is doing because he or she is such an important part, or they collectively, such an important part of the U.S. economy. So as goes Walmart, maybe so goes the market. Anna, what do you see in terms of Europe?
Yeah, that could be a really interesting take then on the US consumer. This is the European picture right now, down by 1/4% on the Stocks Europe 600. And most sectors have been in negative territory throughout the morning, only defensive ones really doing better today. BHP Group, this is one of the stocks that's actually doing pretty badly today, down by 2.7%. Of course, the giant mining business. Revenues seem to disappoint, dividends seem to disappoint. The future, of course, all to do with China and the reopening in China. They are hopeful that that will turn things around for the business. The euro, 106.56 right now, the pound, 120.90. You see the euro going down and the pound going up, despite the fact that the overall composite PMI numbers for these two economies didn't look all that different. 52 in the case of the Eurozone, 53 in the case of the UK, but they mean very different things. The services sector doing so well in the UK is something that could really boost the UK economy. Therefore, how much higher will rates have to go in the UK? That's the calculation that the market is dealing with right now. Did we already know the positives around the European story? And there was some disappointment around German manufacturing. So that weighs on the euro perhaps a little bit. So we see some contrasting moves for European currencies today. Let's get to the rate story, though. Pooja Kumra joins us, senior European and UK strategist at Toronto Dominion Bank. And Pooja, let me start with the German manufacturing story, the way that seems to have knocked the euro, perhaps changed your perspective a little bit on what the Eurozone economy can deliver or not. Give us your latest up-to-date thinking as to how weak things get or how resilient the Eurozone economy proves to be.
Thank you. So we in markets are continuously being informed as how stronger the economy is as what we all had expected, and also the kind of picture central banks had painted for us in the January and the last central bank meetings. So as something that you also mentioned, we are in the state where we don't talk about soft or hard landing, but we're talking about no landing. The economy has turned out to be much more resilient than we had expected. But I think one thing to note is that these are all sentiment indicators. And obviously things have improved remarkably from last year when we had upshoot in energy prices, financial conditions had really tightened, real yields were at the highest. And so this could be a relatively temporary phase. So I would be looking at another 1 or 2 months of data before to conclude that we are actually having no landing. Again, we're not looking for a hard recession, but the way central banks are hiking rates, it also suggests that at some point it will be hitting the consumer. But I think one thing is for sure, that markets will be removing any rate cuts, at least that were being priced for this year. And that is something that is also being showing in the stock market performance, because at the start of the year, the stock market really rallied on expectations of significant cuts from central banks. And that's not the case right now.
Pooja, in terms of the no landing scenario, should we expect it to be exactly as the metaphor would imply? I mean, right now, the Fed is, putting on the brakes or letting off the gas. I guess it would be like this, right, in a plane. So do they kind of get close to the runway and decide no and put the gas back on? Is that how it would work? So cuts are expected in a no landing scenario?
I think right now they all want to be restrictive, as nothing has been as adverse as what they had expected. So yes, we are looking at meeting-to-meeting approach. We will be looking, later today we will get US PMIs, which are also likely to show another rebound. We are going to get the PCE number this week as well, which is again going to be stronger than last month. So I think at this stage, they would actually, there's no doubt that they have reduced their pace of hikes. Central banks are no longer sprinting, but still they have a marathon to run, which means that hikes are likely to continue. We are looking for a terminal for US around 5.5%, which is almost in line with consensus. And I think at that stage, they will likely take a pause.
Little ahead of consensus, 5.5%. What does that mean for rates? I was just showing Pooja the U.S. 10-year at 388. It's the highest level, I believe, that we've seen so far this year. But, you know, last year we were up at 420, 4.25. Do we get back to that level on the 10-year? Could we eclipse it?
I think like we reacted a lot in January, markets right now also are reacting a lot with respect to the move in duration. So I think with treasuries, as they are inching closer to 4%, it's a good level to be long. In fact, we do like being long treasuries here. We do like being long treasuries, even versus bonds here, as ECB members are definitely sounding much more hawkish as compared to the Fed per se.
Can I ask you about the UK story, the gilt story then, Pooja? We're coming up to the start of a new financial year fiscal year here in the UK. When taking into account bond sales by the Bank of England, how do you think the gilt market will perform? I spoke to an analyst earlier who was saying that it is going to be that supply story that's quite relevant. How would you expect things to develop?
Yeah, no, it's a very good question. Like so far, whenever we are looking at all the QT sales, markets have actually absorbed it quite well. There's not much panic around that. But this is because we are basically end of the fiscal year. Supply pressures will start increasing, and the first bit of it will be announced on March 15th. Again, reduced energy prices does mean that the issuance needs for gilts will be much lower than what we were given in November. So we are anticipating around 50 billion less than what the Chancellor had suggested in November. But again, they are still very, very elevated. Total issuance in UK will be close to around 250 billion. This compares to the general average of 100 to 150 billion that we saw pre-2009.
And Pooja, has the PMI data out of the UK? I know that you said with the Eurozone figures, we need a few more months of data to work out what this means. What about the UK? Because we've seen a big jump in the pound. We've seen the gilt markets responding to this very resilient services story for the UK.
Yes. Sorry, I think I missed your question. The line was
apologies. I'm sorry. What do you make of the gilt market in the UK after seeing the PMI data that we got today? The services sector very strong.
Very strong. I think so far we said BOE as well as IMF, OECD, they have been most pessimistic about the UK growth story. And clearly, whatever data we have got so far, it means that UK will dodge a recession. And I think if that's the case, you will see UK gilts actually selling off much more than what we saw in other countries, just because the growth story is not as bad as that we thought it would be. So again, like I do expect gilts to trade around the current ranges, just given the fact that we do need more clarity, both from the Chancellor with respect to the budget, as well as from the BOE, that when does this hiking cycle end?
Okay, we will look for clues then. Pooja, thank you very much. Thanks for joining us. Pooja Kumra of Toronto Dominion Bank. Coming up on this program, as we approach 1 year of war in Ukraine, we will speak to PGIM Fixed Income's lead emerging market economist, Magdalena Poland. That conversation coming up shortly. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, Russia's war against Ukraine has put added pressure on the energy sector, which was already struggling to recover from the COVID-19 pandemic. This invasion has led to a breakdown in supply, meaning the EU has had to start thinking of new ways to keep the heat on in the future. Joining us now is Will Kennedy, Bloomberg's Senior Executive Editor for Energy and Commodities. And Will, we got through this winter. Thankfully, it was warm. I guess now, this year global warming was a blessing, not a curse. What are we looking for next?
As you say, if we think over the last year, Matt, it's a position that Europe would have been glad to take at moments last year. If we look back at August, where gas was more than 300 megawatts an hour, that's equivalent of over $400 a barrel if you convert it into oil. And today we're back at 50, still high by historical standards, but more than manageable. So that's where we are. I think most European policymakers would have taken that if you'd asked them 7 or 8 months ago. But we're not completely out of the woods. I think if you look at the supply and demand dynamics for liquefied natural gas, that's the gas that's cooled down to put on tankers. That's the gas that Europe's depended on this winter because it hasn't had Russian gas through pipelines. That market looks tight for the years ahead. And if global warming doesn't do its thing this winter, if we get a colder than usual winter, and as China's energy demand comes back, you could see a fresh crunch this year. It's too early to tell, but I think that people need to be looking at those two factors, the weather and China.
Okay, the weather in China, crucial then to what happens with the European gas story and its readiness for next winter. Getting through the winter then here in Europe, Will, has meant reliance on LNG, as you point out, on wind, where the wind is blowing, but also perhaps reliance on some dirtier fuels. That takes me on to a headline across the Bloomberg now, which says that EU carbon, the price of it has hit a record €100 as industry is seen boosting energy use. Your thoughts on that kind of news flow?
Yeah, I mean, it's a big price. This is a market which has really changed over the last few years. Europe has put a lot of effort into making sure that the supply of those credits remains constrained because this is its main policy tool for encouraging people to use cleaner power and making coal use and gas use more expensive. I think the recent rally is actually about the optimism that lower energy prices will boost demand, will boost industry's use of energy, and that therefore people are going to need to go into the market and buy more credits. So in a sense, it's a story about European energy markets healing.
Okay, Will, thanks very much. Bloomberg's Will Kennedy with the latest on energy markets. And joining us here on set in London, Magdalena Polan, lead emerging markets economist at PGIM Fixed Income. Magdalena, really nice to have you with us. So a year since, of course, the invasion of Ukraine, and energy markets have been on quite a journey. European economies have been on quite a journey since that point. When you look across Eastern European economies, those more emerging markets, are you surprised at where we've seen resilience and where we've seen vulnerability? What have been the standout performers to you?
We're not surprised by the resilience because these economies went into this conflict having incredibly strong economies, strong frameworks, strong growth, and that reliance also on the integrated European market. They also went with relatively okay fiscal positions, even despite COVID. So we're not surprised by the solid performance. Of course, that put a lot of pressure, though, because of the increase in inflation. You just talk about the energy market, and that hit absolutely everyone. And we have to remember that east of Europe, that weight of energy in the inflation basket and the role of energy in just the share of spending for people is higher than in the West. So that was definitely painful and added to that cost of living. But so far, I think that resilience and the success of the previous reform have proven to be very valuable.
Matt, jump in.
Magdalena, when you're building your models at PGIM or tweaking them, how do you factor in geopolitical headlines? We just got a big one across the Bloomberg terminal. Russia is going to suspend its participation in the New START treaty. We heard a little while ago from Putin that Russia will not allow NATO in to inspect its nuclear objects. And there's been talk about China possibly arming Russia in its fight against Ukraine. It seems to me the global peace is kind of breaking down. How does that factor in to the calculus of fixed income?
That fits into our calculus regardless of the country we're looking at. So this is so important for our medium and long-term outlook for not just the region, not just Europe, but the global economy. We see that we are in a world of a large geopolitical shift of increased risks, increased geopolitical risk, increased or decreased globalization, a much more acute need to manage cross-border risks. So that stability that we have experienced since the fall of communism is probably coming to the end. And that is, of course, could be more painful for the smaller emerging markets, given that they don't have the luxury of having large pools of domestic capitals, they don't have the luxury of having a reserve currency, but they would ride this boat together with the Western countries. Well, one thing that we look very carefully at is where they stand geopolitically. And the good relationship with the EU, good relationship with NATO will be for us one of those differentiating factors.
But it must be also very, or to some extent, inflationary, Magdalena. When we talk about deglobalization, it's just this big, broad concept. But when it comes down to reshoring or friendshoring or whatever you see a lot of these countries in the West doing, it really just means a higher push on prices, doesn't it?
Yes, it does, and it means the same for for both the EMs and for the DMs, and especially now in Europe, because as we talk about the impact of the war in Ukraine on the energy market, this gave an additional impetus in Europe to shift to other energy sources, and with that effort now accelerated, this will add to the price pressures. But looking ahead, as we talk just about these changes in the geopolitical picture, that also affects exactly the view on long-term inflation trends and what it means to run monetary policy and stick to the inflation target right now.
Can I ask you, Magdalena, about the Russian economy? Because clearly the sanctions, we're watching still President Putin delivering his State of the Nation address. Clearly the sanctions environment that the West has introduced was designed to do damage to the Russian economy. And in some areas it might have succeeded. But in some areas, Russia has found new trade partners and has managed to keep up production of some commodities, for example. And the West's vulnerability to some of the things that Russia makes, like fertilizer, has been well demonstrated. Have you seen resilience or vulnerability in the Russian model?
I think we've seen both. So the Russian economy has been resilient in the past, given its large assets, its relative lack of openness. And we saw that also that the cleanup of the economy that the authorities introduced in the past definitely helped. But we can also see that Russia has to find new trade partners. And it may need to rely on partners like China too much for its own liking, becoming almost dependent on one key buyer of its oil and gas, which is not exactly a great outlook for the economy. Also, I think what you saw in it is also that as we come back to this big picture and the geopolitical changes, we can see that trade and finance is again becoming a part of international geopolitics. And Russia has used that for sure, but so did Europe with the impact on the energy market.
Magdalena, thank you very much. Thanks for joining us. Magdalena Polan of PGIM Fixed Income joining us with thoughts on emerging markets today. And just to mention that President Putin has just concluded his State of the Nation speech. You can see the wide shot of the room there and plenty of applause for him. Just to reiterate some of the headlines we got then coming through from that address, doubling down on the war in Ukraine, that will continue until Russia meets its objectives. That was our headline earlier on. And then just more recently, Russia won't allow NATO to inspect its nuclear objects. Russia won't be the first to resume testing of nuclear arms. Russia will test nuclear weapons if the US does it first, one of the lines here, and also says it will suspend participation in the New START treaty with the US. We'll continue to monitor what comes to us from Russia today, and you'll find more of that on LiveGo. This is Bloomberg.
is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Let's get a look at what's ahead today at 6:45 Eastern. The NATO Secretary General, the Minister of Foreign Affairs of Ukraine, and the EU Foreign Affairs head hold a joint press conference in Brussels. The U.S. consumer is in focus, as we've been telling you. Walmart and Home Depot report results before the opening bell. And then U.S. PMI data is out at 9:45. That's followed by U.S. existing home sales data at 10 a.m. Finally, President Joe Biden meets with Eastern European leaders in Poland and is scheduled to deliver remarks. That's it for Early Edition. Surveillance is up next with Tom, John, and Lisa. This is Bloomberg.
anxiety levels, which are already through the roof, I want to talk about the social consequences of this, because it seems like an environment where inflation is high, growth is slowing, the Fed is explicitly trying to boost unemployment. Like, it seems like that is probably the worst environment for, your average person on the street. And it almost seems like the Fed's goals here, they're almost anti-American at this point, or like anti the American dream, right? Like housing more expensive,
crushing the housing market,
crushing demand, crushing the labor force. Like, what are going to be the social consequences of central banks, having to do this in order to put a cap on price increases?
They're going to be severe. We're already seeing, of course, a backlash against free market, backlash against trade and globalization, even a backlash against technology, a backlash against, laissez-faire policies, because there has been a massive increase in income and wealth inequality. This is leading to populism of the extreme right and or of extreme left in many countries across the world, and authoritarian regimes becoming more popular across the board. It's a repeat of the 30s, literally.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
Market was priced for a soft landing, was very enthusiastic about a soft landing. And we had called this year a roadmap to recovery.
The likelihood of a soft landing, a garden variety recession, even maybe a small chance of a hard landing, that's all there.
Central banks now have to make a judgment on how persistent those upside surprises are going to be.
We're in the camp of a couple more rate hikes for the Fed, but not giving up on the disinflation story.
If the Fed really wants 2% inflation, they have massive amounts of work in front of them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Yields up, stocks down. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Back after a long weekend with futures negative 0.8% on the S&P 500. TK, I've got to say, the data out of Europe, a whole lot better once again.
Well, out of Europe, it is a surprise it's better, but you don't see it in the tape with the VIX back out to 22.35. It's an adjusted tape, and I really suggest, John, we need to reset on this Tuesday after the back and forth. I think strategists getting out front. Yes, Europe good. Mike Wilson's got some real caution.
I need to reset with some of the earnings as well. We'll get to that Mike Wilson note in just a moment. Through this morning, going to hear from Home Depot, Walmart, some of the big retailers reporting this week in America. At least we get Home Depot right now.
So less bad. I guess that was really the issue in terms of the decline in the year-on-year sales. To me, the most interesting aspect, though, is they're boosting their dividend by 10%. This, to me, follows on what we've seen from other companies, basically saying if we have extra cash, we're going to return it to our investors. Still, they did see a decline. Their net revenue did beat. I mean, honestly, all around, it's better than expected in many areas, and yet still facing a lot of potential headwinds.
To invest $1 billion extra annually in frontline staff, Tom, the extra staff investment to start in the first quarter of fiscal 2023. I imagine we'll see much more of that too.
That's going to be the investment part, and the look back is maybe pretty good, but the sum of the headlines is actually, to me, pretty negative as well. From a 317, 318 close a long time ago, John, Friday, and you come down now to a center tendency of about a 309, 311. The guidance forward here, and particularly on revenue, I think is what I'll have to focus on.
The stock is negative in the pre-market by about 1.9%. We'll pick up on that story in just a moment. Equity futures negative 0.8% on the S&P 500. The broader price action looks a little something like this. If you look at bond yields, much higher by 6 basis points at 387.67. The data out of Europe on the services side a whole lot better, including from the UK. The UK data improves on services. UK gilt yields at the very front end of the curve, higher by 12 basis points. So this lift is across the board. Bit of dollar strength out there for you, Tom. Euro dollar 106.49.
Are we out to 4% watch on the U.S. 10-year yield? I mean, this is part of this shift in this great Tuesday reset that we're having here. Whether you look at equities, bonds, currencies, or commodities, Ed Morse to join us later on oil. John, to me, it is a yield reset.
I couldn't agree more, Tom. Out to 4%, getting close on a 10-year. We're through that level on a 7-year, Lisa. On a 7-year note, we're through 4% and up 7 basis points on the day.
This is a global move also, and we'll get into that in just a minute. I do want to just reiterate what we got from Home Depot. Basically, a kind of muddied picture here. The U.S. doing better than good, the rest of the world perhaps less so, and that really is what stands out to me because the declines are much less and less than expected in the U.S. versus globally, where there were some disappointments. To me, I think it'll be interesting as the heart of retail earnings kick off. We've got Walmart at 7 a.m. Eastern. How much do we see them able to pass along the price increases to the consumer versus how much more they're going to have to pay to staff? That whole $1 billion in hourly frontline staff really from Home Depot really speaking to this. At what point do we see that margin compression? We get Target, Dollar Tree, Kohl's, Lowe's, Macy's, Costco all in the next couple of weeks. Today, President Biden is meeting with Polish president and other NATO allies in the Eastern European flank. The key here is, as they celebrate or not celebrate, memorialize a year of this war in Ukraine. How much more aid is the alliance going to provide to Ukraine? The U.S. announcing about $500 million in additional aid in the surprise visit to Kyiv. And just building on what you were talking about, John, with the PMIs, the data that we got out of Europe. In the U.S. at 9:45, we get the latest read, the S&P Global Manufacturing and Services PMI in February. In Europe, we saw the biggest jump in Eurozone business activity, the composite PMIs, in 9 months. And this really speaks to this is good news, bad news, because you're seeing that yield in that 2-year term lift.
The manufacturing is still a little bit soft over in Europe, but certainly the services component of that PMI really starting to improve. Who remembers this conversation with Bloomberg's Francine Lacqua and the Credit Suisse chairman back in December on outflows? Take a listen.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
The outflows have stopped. Reuters reporting that Switzerland's financial regulator is reviewing those comments made back in December, Tom, on outflows. Had the outflows stopped? What did he know? And was that an accurate representation, characterization of those flows into and out of the business?
Every regulatory cadence is different. There's been a huge mystery here of what Swiss regulators do with their 2 big banks, UBS, Credit Suisse, all sorts of Zurich and cultural baggage there. And this seems to be one of their ways to get in. Very different than the United States. I would suggest different banking authorities in the United States, if they were New York domiciled, would be very different. I would focus, John, on a price to book 0.16. I can state to you I've never seen that statistic.
Brutal. Lisa,
Never.
the stock's down 7% in Switzerland. We're trading in and around 250.
It also raises the question of how much more have some of the withdrawals continued, right? I mean, they've basically been saying things have stabilized. They have continued to say that. So at what point are we getting misinformed, even to this day, when they say they're retaining some of their clients?
Plenty of coverage through the morning on that. Credit Suisse at 258. I promise you that note from Morgan Stanley and Michael Wilson. The bear market rally that began in October from reasonable prices and low expectations has morphed into a speculative frenzy based on a Fed pause pivot that isn't coming. Ben Laidler joins us now, global market strategist at eToro. Ben, if we can just kick off by asking for your comments on that, because I imagine you might see things differently. I'll read it again. The bear market rally that began in October from reasonable prices and low expectations has morphed into a speculative frenzy based on a Fed pause pivot that isn't coming. What do you say to that, Ben?
I guess I respectfully and partly disagree. I think this rally has been very fundamentally driven. It's been this easing inflation and interest rate shock. And less bad growth data, which you've just been talking about. I think that's very fundamental. I guess what I would agree is there's going to be a pause. I mean, you cannot annualize the degree of performance we've had this year. I mean, that would take you to twice what the S&P 500 has ever done in a year. And maybe some of the disruptive tech names, which are up on average, by a third this year, even more than that off the October lows. I mean, with bond yields now rising and investor sentiment, maybe not as depressed. I mean, those are absolutely due a breather.
Yeah. Ben, just as the VIX is a measurement here, and I know we went out to a 25 level in December, but we've had a spike up in the VIX showing the angst out there. We're back above 22.40. Does Ben Laidler shift from a measured bull to a more outrageously optimistic bull as the VIX adjusts?
Well, I think we can argue that the VIX is probably a sort of broken indicator here, but I mean, we would definitely be pulling back on some of the higher risk elements of the market here. I mean, I just said, if you've been lucky enough to ride that sort of 50% disruptive tech rally off the October lows, I think now is the moment to rotate into cheaper, more cash flow, sort of defensive bits of the market. I think October was the low. I think this is very fundamentally driven, but these higher bond yields are beginning to put a ceiling on valuations. And what was extraordinarily depressed investor sentiment 3 or 4, months ago is, now less depressed, and that has been the sort of gasoline that's been poured on this rally in the last in the last few months.
Ben, is this a question then of leadership in the equity rally and where you see it coming from and a shift there, or is this a question of you becoming perhaps less optimistic than you have been in the past because of the challenge to the leadership we've seen year to date?
I think the drivers are just different. We've seen a lot less growth risks. I think earnings are becoming less of a concern now with all the data that you're seeing. But we're seeing a cap coming in from valuations. And the rally this year has all been driven by valuations. With bond yields now rising, our sort of fair value PE for the S&P 500, it's down at 15, 16 times. It's not sort of 18. Now, that's an issue in the US. That's much less an issue in the rest of the world. Why is Europe being the best performing region in the world this year? Yes, you've had a sort of growth story, but you're coming off, 11, 12 times earnings. So I think, it's cheaper, more cash flow generative stocks that are less exposed to this sort of potential valuation reset.
Ben, I got to be rude here and take every advantage of your time as an award-winning strategist at HSBC. They're in the news here, and I'm fascinated, Mr. Laidler, if you feel you can envision a separated HSBC into their Asian business, which generates 72 or 78% of profits, and everything else in London. Can Ben Laidler believe there could ever be separate HSBCs?
I don't know. I think history tells you that when you have these, these big companies and you try and split them up, especially in regulated businesses like banks, it's not to say it's impossible, but it's certainly it's certainly difficult. But, the broader point there, I think, they reported seemingly great numbers today, right? And that's been leading, banks have been performing very, very well. You touched on it with CS, which hasn't been performing well, but this combination of strong earnings beats, higher interest rates, and, well under book value valuations is a pretty attractive proposition. And, we touched on Europe earlier. It's been leading the European rally.
That's how you address that question, Tom, without addressing that question. Did you like that?
Did I address it? I addressed it. I didn't want, I want Ben to come back.
Of HSBC, Ben Laidler there. Ben, thank you, sir.
Ben, thank you.
Ben Laidler of eToro. As if he was ever going to comment on that, TK.
Let's review this. Ben Laidler was at HSBC. Ben Laidler was at HSBC. He alone, sort of like Mike Wilson last year in the gloom.
Sure.
Ben nailed the Christmas bull market a couple years ago.
I think it was 2018.
Nailed it. And then, he went to London with eToro in a separate thing. But he's lived HSBC. I mean, we get Max Kettner on. He's not going to give us a straight answer. I'm hoping to get an answer from Ben Laidler.
He's a classy guy. I don't think it's about to, throw any mud at his old employer, Tom.
Can you imagine a separated HSBC? I can't.
We've been talking about it for how long now?
A century.
Years and years. On the bonus pool over at HSBC, did you see that, Lisa? The lowest since 2020. The bonus pool shrinks again, and we've seen that from bank to bank, bank to bank.
So how do you retain some of the talent if you have this kind of pressure at a point when,
How do they do that when they raise a dividend 10% and they show record profits, as Ben mentioned? To me, it's out of body.
Are you acting on behalf of the HSBC employees?
No, Max Kettner called me and said, say something, Tom.
Well, you've said something now. Futures down about 0.8% on the S&P. To kick off a brand new trading week stateside, yields higher across the board here in the Treasury market, abroad as well. Bunds, gilts, take your pick. The data improves on the services side. Once again, your 10-year, 387.28 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin has delivered a defiant message on the war in Ukraine. In his first State of the Nation address in almost 2 years, Putin vowed to continue the faltering invasion until Russia has achieved its goals. He also threatened a backlash if the U.S. and its allies supply Ukraine with long-range missiles. President Biden is seeking dividends from his surprise trip to Ukraine. The president's hoping to rally new support for the Ukrainian efforts against Russia as he meets with Eastern European leaders in Poland. Shortly after President Biden's visit to Ukraine, the U.S. announced $460 million in new military aid. China is urging the world to stop saying that Taiwan is next after Ukraine. Foreign Minister Qin Gang says that certain countries should stop fueling the fire by blaming China and saying, quote, Ukraine today, Taiwan tomorrow. Beijing has been trying to distance itself from Russia and portray itself as a neutral force for peace. In Turkey, a pair of earthquakes rocked a southeastern province 2 weeks after major quakes in the same area killed more than 40,000 people. Monday's quakes killed at least 3 people and injured more than 200 others. Turkey's government has announced that it will start building about 200,000 homes in the hardest hit areas. And HSBC will consider a special payout after the sale of its Canadian unit amid an ongoing battle with Ping An Insurance Group of China to break up the business. Fourth quarter earnings rose 92% to $6.83 billion, beating estimates. On the credit side, the bank's results suffered as expected credit losses almost tripled to $1.4 billion in the quarter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. The moment news breaks, no one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. Season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Putin thought Ukraine was weak and the West was divided. As you know, Mr. President, I said to you in the beginning, he's counting on us not sticking together. But he's just been plain wrong. Plain wrong. And 1 year later, the evidence is right here in this room. We stand here together.
Approaching the 1 year anniversary of Vladimir Putin's invasion of Ukraine. That was President Biden during a surprise visit to Ukraine. And Tom, phenomenal to see an American president on President's Day in a war zone without an active American military presence. That's different to what we've witnessed over the last few decades.
I thought it was a huge deal. We make jokes about February 20th and tomorrow's George Washington's birthday, but the symbolism, John, is really, really tangible. And, I thought the American media picked up on it fine, but mostly I believe it was a signal to the allies of Europe.
Yeah, and let's be clear about that word surprise. I think the visit itself was not a surprise. The timing was. The timing was a surprise. I think we expected at some point, perhaps around the anniversary, given that the president was heading to Poland, Tom, that perhaps he would make that visit.
The history here for America is really sensitive, John. This is about a country that always believes wars are going to be short, and we're always proven wrong. And, of course, we're coming off Afghanistan, which arguably was generations long. But, year two, there's a whole different tinge here. And 3 days we're to the anniversary?
I couldn't agree more. I think we framed it last week in the following way, Lisa, and I think this is probably an appropriate way to think about it from a financial markets perspective. It feels like the immediacy of this war has just faded, almost fallen off the radar because of the way the energy story has evolved over the last 12 months. This is not where people thought the energy market would be based on how long this war has gone on for.
Since we haven't seen a massive disruption in the energy market akin to some of the worst fears, is that really justification to say that the war has decelerated or somehow gotten more resolved? Because it hasn't, and that is really what's on the ground and what you're feeling. What we felt over the weekend as we heard that the U.S. was accusing China of potentially giving aid to Russia, and
or at least considering it.
Considering it, exactly, that they were considering this. What is the fear that could be another leg in escalation that really creates a new nature to this?
That's the ultimate fear, and I'm pleased Lisa brought that up, Tom. The fear is now that we could end up in some kind of proxy war between the United States and China. That would be something else.
Well, that would be a step further as well. And I'd also know Johnson and Truss in England lecturing on jets this weekend as well, just as a separate side story. Let's do this. Let's jump into this. And for those of you on radio, the image here with our Anne-Marie Horton, our chief Washington correspondent in Poland today, is extraordinary. It is the most important image because, as you know, Anne-Marie, the justification of this, of Vladimir Putin, as Angela Stent told us in Putin's World, is he wants to go back before Stalin, back before Lenin, to some time of a Soviet view of the West. And that tower behind you in Warsaw says all, the Joseph Stalin Tower, that the leadership of Poland and the Polish people, they want to bring that tower down.
Do. This is a very controversial clock tower in Warsaw and really reminds the Polish people of the hold of the Soviet Union had on Poland. And now, of course, the concerns of Russia and his invasion of Ukraine and the border Poland shares with Ukraine. This is a message that President Duda will bring to President Biden when they meet this morning. One, to make sure that security continues, potentially an ask for more U.S. soldiers on the ground in Poland. And it's not just about the security of these neighboring eastern countries of Ukraine because of the security concerns. It's also about the financial concerns. Duda, speaking to the Financial Times overnight, was talking about the fact that if there's not security in Poland, they are concerned about how their economy could withstand this. And they want to make sure this economy remains open for foreign direct investment. That means you have to have a secure country. So it's a pivotal moment for President Biden, not just because he's on the heels of this surprise cloak and daggers trip to Kiev, but also the fact that it is a signal to the Polish people and neighboring eastern flank about the fact that the U.S. is in this for the long haul.
Do you perceive in your reporting, Anne-Marie, that the distribution of any U.S. troops on the ground wouldn't be just troops in Germany from my youth, or even troops in Poland, but troops distributed from Helsinki down to Istanbul?
Well, what the president is going to be also doing while he's spending 2 days here on the ground in Poland is going to be meeting 9. So these are the Eastern Flank members, Eastern Europe, former Soviet Union members who joined NATO following the collapse of the Soviet Union. These are really important countries. They're countries that have been sounding the alarm for years about the concerns about Russia and Putin's potential wanting to amend the map, what Angela Stent has called for in the past, of how Putin's vision of his sphere of influence. But then, of course, Tom, yes, we're still waiting on go-ahead from Turkey to bring in those Nordic countries to NATO, something that the president is definitely likely going to mention, that not just resilience of NATO in his speech this evening in Warsaw, but also the expansion of NATO under his leadership.
And Ray, Tom was mentioning the speech over in Britain about the potential for fighter jets, and we did see President Biden commit almost $500 million of additional aid to Ukraine. However, it was much of the same in terms of what the weapons were, what the ammunition, what the radar detection is. What's the next phase of support in terms of just material?
Right, this is fresh supplies, but not fresh new material in terms of what the United States is being willing to give to Ukraine. I mean, and there's been calls from Republican senators. Lindsey Graham over the weekend at the Munich Security Conference saying at least start training Ukrainian pilots on these fighter jets. And yesterday, while he Biden's trip to Kiev and said it was the right thing to do, he wants the administration to take the next step and give them these fighter jets. When you talk to Ukrainians, they're always asking for more weapons. They obviously want these F-16s. That was immediately clear as well when Zelensky visited Washington. But there's also something else. The Ukrainians have changed in tone. And you heard this from Dmytro Kuleba, the Ukrainian foreign minister. And what he said is last year was about weapons, weapons, weapons. That was the message to the West. This year, it's about sustainability and speed of delivery. And this is how they think they're going to be able to make sure they can withstand a fresher Russian offense in the spring.
Anne-Marie, you've just gone through the needs of the Ukrainians abroad. Can we talk about the pressure at home? Some of the criticism coming from the other side is that the president is in Ukraine and not in Ohio. How's he balancing that?
Ohio. Yeah, this is coming from some members of the Republican Party, because you obviously saw in early February there was this train derailment in Ohio with toxic waste, incredibly devastating and concerning for individuals in Ohio. And what some members of Congress are saying is the president is in a foreign country giving more aid to Ukraine and is not visiting Americans in Ohio. At the moment, John, this is definitely a thread that we are tracking, and that is being picked up in U.S. media. And for these members of Congress, definitely something that they have concerns with the administration. But we should also say there are other Republicans who, like Mitch McConnell, like Lindsey Graham, they were at the Munich Security Conference telling the Biden administration that they want to see more aid going to Ukraine. And Mitch McConnell, the Senate Minority Leader, was talking about the fact that he thinks that the Republicans do not support the aid and the fight that the U.S. is taking on, and this unwavering support for Ukraine is greatly overshadowed. So there's a little bit of a dichotomy within the Republican Party back home, but certainly there's criticism towards the president for this trip.
AMH, wonderful to hear from you. Fantastic coverage, as always. Anne-Marie Hordern there. With the latest over in Poland, we'll hear from the president a little bit later on this morning, Tom. But ultimately, that's the balancing act for the president of the United States right now, TK. The pressure to deliver more to Ukraine and the pressure at home to do more here.
Yeah, I agree. It's a domestic and a foreign issue, but on the foreign issue, it's simple. Putin is speaking in Russia. I believe we've lost that feed. Maybe he's done speaking, John, but the bottom line is he reverts back to what we talked to Anne-Marie about. He's fighting for his, quote, historic lands. That takes us right back to 364 days ago.
Equity futures right now down 0.75% on the S&P 500. That conversation with the president coming up a little bit later, 11:30 Eastern Time. The president of the United States addressing the people of Poland, the people of Europe, and maybe even some of the pressure at home as well to deliver more. Futures negative. This is Bloomberg.
we're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Coming off the back of the first two-week loss on the S&P 500 of 2023 and taking some more weight off this rally year to date, we're down about 0.75% on S&P 500 futures. On the Nasdaq 100, negative 0.9%. This bond market is not helping out. 2s, 10s, 30s look a little something like this. Yields up again by 4 basis points. 4.66 on a 2-year, on a 10-year up 6 to 3.8747. Blame Europe maybe this time around. The services data out of Europe, the Eurozone and the UK, better than anticipated. This leading to a weaker euro. Believe it or not, euro dollar negative 1/3%, 106.55, teeing up higher rates at the Federal Reserve, at the ECB, and maybe even, Tom, the BOE. That data was pretty impressive today. And even the UK now, the conversation started to creep in. Perhaps they can avoid recession too.
It's fascinating to me, John, and I'm going to take it. I'm going to sound like a Michael Darter redux, but the bottom line here is I take it back to, okay, real growth is actually pretty good, but then overlay that substantial inflation, and that gives you a nominal GDP, which keeps the engine going, even if it's maybe not a healthy engine.
It keeps these central banks going too.
Oh, big time.
And that's ultimately the issue for people in markets.
Yeah. We're going to have to see. Right now, because of time, every second is precious, with Edward Morse, Global Head of Commodity Research at Citigroup, as public service to the nation a few years back, and of course, Dr. Morse on hydrocarbons, on oil, on the global view. Ed, I have never seen from you a more indirect note. Edward Morse, stealing from Thatcher, says expect the unexpected. Define the unexpected out there along a burgeoning, reopening Pacific Rim.
Well, there are so many wildcards that are now abounding that it's really hard to know where to start. We can start with the China reopening, long anticipated, over-anticipated. Now we're getting down to reality. The fact of the matter is that China may get back to where its oil demand growth was 2 years ago. China is on its way down. It's moving out of the world of oil consumption, and it's almost imminently there. After this recovery, I'd say it's the last hurrah for demand in China and close to the last hurrah for demand around the world. So that, for starters, is one of the things that's really impacting the market.
I look, Ed, at the dynamics here. Is it a study of supply or a study of demand? Which is most important to you and your Citigroup team?
I don't think we can separate them out at this moment. We're in a period of time when the world is definitively moving off of oil. We're coming out of a slowdown eventually, which will have a flash of oil demand. But it's really stunning to look at large countries. We look at the 3 major economies of the world. Europe's demand was down before the pandemic, and it's going to continue to go down. China's demand, if we look at major fuel uses, their demand for diesel peaked in 2015. They're coming back to a level that they're going to start retreating from. And indeed, we expect diesel demand in China to be lower this year than last year, and that's because of the surprise the world had with moving from natural gas, where prices were extraordinarily high, into diesel. And for China, that demand switch was between 300 and 500,000 barrels a day, and they're going back to natural gas now that prices have come back to earth. And then we look at the United States, and the stunning part of the U.S., at least in terms of weekly data, is that the U.S. demand is down below where it was a year ago. And U.S. exports are up significantly from where they were a year ago. The U.S., as a result partly of the release of strategic oil, but only partly because of it, has become by far the largest gross exporting country in the world. We're exporting close to 10 million barrels a day of oil, and that's after the SPR release was over. That's more than Russia. That's more than Saudi Arabia. It's more than both countries combined. And our supply is way up. If we look at real liquids, oil, biofuels, natural gas liquids, and the gains we get for running our refineries full out, we're a 21 million barrel a day producing country. That's kind of extraordinary, and nothing that we expected a year ago when this Russia-Ukraine conflict started and emerged.
So let's take a step back, because I'm curious how the Citigroup view of the world dramatically differs from the JP Morgan view of the next 10 years. Are you saying that demand is going down because of a lack of activity, a sort of more recessionary type of environment that perhaps the data points to, or is it because of renewable energy, because of electric vehicles, because of alternate uses that we've seen the transition really accelerate simply since the pandemic?
We actually have both going on. Yes, the transition is accelerating, and we can see that in electric vehicle sales, particularly in China, where it's 39% of all sales in 2022, phenomenal growth in Europe, and the U.S. is really not far behind. But it's also something happening in the trade environment. We've seen obstacles to trade being put in place, starting in the Trump administration in the United States, followed by what we call Bill, CHIP, and IRA, the three extraordinary bills that were passed in the U.S. over a 1.5-year period of time, which really moves to block trade and bring a various set of things home, not home only to the U.S., because Buy America also includes some 20 free trade agreement countries. We have Europe that was moving in the same direction, and that started before Europe started mimicking the U.S. In trying to put forward something like the IRA bill. And we have China that, for energy and other security reasons, is pulling back from seaborne trade. So we have a retreat from trade that really started in 2017, 18, and it's been reinforced with various mechanisms. So we're not going to see, with this recovery, we're not going to see this greater pull on demand coming back with a recovery. So yes, it's a little bit of both.
So Ed, how come you're recommending to investors that they go into commodities? This is an attractive place to go.
It is an attractive place to go, and if we look at investments in the renewable side, they're blossoming. The issue is where to go, where is the greatest opportunity, and where is the greatest danger. But if we look at the numbers on the energy transition side, the world had gotten to around $850 billion worth of investment in 2021. And by the time we got through 2022, that investment turned out to be $1.1 trillion. And to compare that with oil capital spending, it peaked in 2014 at around $800 billion. So the opportunities are there. They're there in carbon capture. They're there in hydrogen. They're there in the areas where this new technology is working. That includes industry, it includes transportation, it includes buildings. So the opportunities for investors is really high. Emphasized that by the tax credits given and the direct subsidies offered by major governments in the world.
Ed, this was wonderful to get your perspective, as always. Ed Morse there of Citigroup, and our apologies for that patchy connection as well. No apologies for this. Let's take a look at Home Depot, HD. We look like this. We're down by more than 3%. These are the numbers. So they're now forecasting flat sales growth, a decline in earnings, and they're going to have to spend $1 billion to increase hourly wages for sales staff in a tight labour market. We get Walmart at the top of the hour in about 22 minutes time, Tom. I wonder if some of these themes come up in that report as well from that big retailer in just a moment.
Barry, I don't have it in front of me, but is the pricing power and unit growth study, which was not all that optimistic, and I really wonder if that's the theme here we're going to see is finally they can't raise prices. Is that PepsiCo did the same thing? Can they raise prices? Yes, it's been effortless. It appears, and maybe that's over. I've got a linear function out of the pandemic of Home Depot from 200 to 400. We come down into a zone, and right now here off of a 305, 306, 268 was at Home Depot level of the October angst that we had.
You've nailed it, Tom. Pricing power, tight labour markets, and it comes down to margins. What are they going to look like for the year ahead? That's Home Depot. We need to talk about Walmart in just a moment, Lisa.
And Walmart might be a cleaner read just simply because Home Depot is that much more connected to the housing market. So is there some sort of greater weakness there? That said, if you take a step back, this is an example of how Mike Wilson could potentially be right even if we don't get a recession. Basically, if you start to see real margin pressure, if you start to see a lot of these companies have to pay up to keep employees but not able to raise prices on the consumer that have seen their real wages go down so much over the past few years, all of a sudden you see margin pressure that could really create some weakness for stocks, even if the economy muddies along.
He doesn't think, Tom, these companies will be able to cut costs quickly enough to catch up with what he thinks is going to be a real earnings deceleration.
To his point, that's the shell game here. I'd also point out, is it a tech valuation? No. Home Depot giving you 19 times, 18 times earnings. It's not like a 25 stock, but nevertheless, it's had a heck of a run, but now runs into that margin angst as well. I look at EBITDA, 16%, is 16 cents on the dollar, is pretty good. John, free cash flow pre-pandemic, 10, 11 billion. Now it's 16 billion. Not bad.
You see the latest take from Mislav Matejka over at JP Morgan on this equity market.
Please.
Here's the line from him. Historically, equities do not typically bottom before the Fed is advanced with cutting, and we never saw a low before the Fed has even stopped hiking. I'll share that with you again. This is basically what the bears are pointing out. Equities do not typically bottom before the Fed is advanced with cutting, and we never saw a low before the Fed has even stopped hiking. That from JP Morgan's Mislav Matejka. So Morgan Stanley's Mike Wilson is effectively saying that the Fed pivot pause is not coming. Mislav Matejka actually went one step further a little bit earlier this week when he said the following, and I think this is an important line. We could indeed see a Fed pivot, but even if we do, perhaps only it's in response to a much more problematic macro setup than what the market is currently looking forward to. So, Lisa, that's the pushback against, okay, even if we do get a pause, a pivot, rate cuts, you've got to think about why we would be getting them, and perhaps they wouldn't be for good reasons.
If it's suddenly a rapid deceleration in the economy, it's not exactly going to be a phenomenal story for all risk assets. That said, if you start to look at what's getting priced in, people are not really looking for rate cuts this year. You're seeing a peak terminal Fed funds rate of 5.3% going down to 5.1% by December. So a much lesser kind of divergence from what the Fed keeps saying, and yet our stock's really getting the message.
You've got reading to do tomorrow afternoon. Do you know that, TK? Fed minutes. Fed minutes are coming out.
Oh, I thought it was
Highly
Formula One
anticipated.
racing. I'm studying.
Oh, are you?
Yeah, I am.
How far have you got in your study?
I'm fascinated by it. I still don't. I'm an American. I really don't get it, but at the same time, I get it. I mean, there's only 20 drivers.
What research did you do this weekend on Formula One?
I watched season 1 of the Netflix thing. I watched a special on Michael Schumacher.
Very cool.
And I want, I mean, Mrs. Keene is like, what in God's name are you doing? All she can hear from the library is.
What a sound, though.
Vettel's sitting on my lap, scared.
It used to sound even better. They start testing this week.
I know. I'm ready.
And
I
the
think
season
we need.
begins the following weekend.
Baku. I think I can see
you
the
three
of us in Baku. Yeah.
Is that why you've taken an interest?
I've
looked at the calendar.
I'm looking at it.
Beautiful places.
And my basic take is it's easy to go for Mercedes and Ferrari. We need to find the tots of Formula One. And I'm really, I could go either way.
Well, probably McLaren.
Ford's coming back, but maybe a McLaren, I think. Yeah.
Probably McLaren.
We could do a remote from McLaren.
You're going to be a McLaren fan, is that?
No, I haven't decided yet. I'm still studying. I'm like 4 years behind.
Okay. Futures negative 0.7. You decide in the commercial break. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin had a warning for the U.S. and its allies in today's State of the Nation address. The Russian president threatened a backlash if they supply Ukraine with long-range missiles. Now, Putin vowed to press on with his faltering invasion. He also said Russia will suspend its participation in the New START nuclear weapons treaty with the U.S. China is now seeking to convince the world it's a neutral actor that can help end the war in Ukraine. That's coming a year after it declared a so-called no-limits partnership with Moscow. Chinese State Councilor Wang Yi is set to visit Russia after floating a fresh peace proposal to end the conflict. The U.S. has disparaged China's efforts. Shares of Credit Suisse hit a record intraday low. Reuters reported that Switzerland's financial regulator is reviewing comments made by the bank's chairman, Axel Lehmann, on outflows having stabilized. But results later show that outflows worth tens of billions of dollars continued. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Obviously, we had outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Those comments attracting a ton of attention. That's the Credit Suisse chairman speaking to Bloomberg at the end of last year. And this is why it's attracting attention. The Swiss regulator, according to Reuters, Tom, reviewing those comments that the chairman made on outflows stabilizing. That quote, they'd basically stopped, Tom. We've gone through the earnings results published this month showed that further outflows worth tens of billions of dollars continued until at least the end of the quarter. So attracting some regulatory scrutiny, according to Reuters, in the last 24 hours, and the stock attracting some selling. We're down by 6%, TK, 259.
Yeah,
Credit Suisse
it's the way
stock.
it's the way we're down, John. I mean, we're really coming down here hard. We came down to a 2.522. Yeah, we bounced up in the last 2 hours, John, but then we roll over here moments ago.
What does this company, this bank, want to be when it grows up? And how long have we been asking that question? 10 years? Still?
He's so rude because he's visited Zurich so many times.
Every time there's new leadership at this bank,
you're right.
It seems to me that they make blunder after blunder, error after error.
It's completely unfair, but John, I think you and I are on the same ground, that from Brady Dugan on, it's sort of been a blur. I think is how
I remember sitting there with Brady more than 10 years ago.
You were our guy there.
Asking the same questions, Lisa, and we're asking the same ones now.
The problem is that they really have been supported by the wealth management side. And if people lose faith on the wealth management side, that's the issue, because we're dealing with a situation where what are the other ballasts of a bank that has really lost clout in a lot of the international banking sectors?
We are advantaged at Bloomberg. It helps to have journalists